Good morning. Good morning, everybody. NQ still dropped, man. We're still in our Tesla position. We're still eyeing a buy on Cciv, which dropped tremendously after hours. We're kind of speculating, was this a buy, a rumor, sell the news type of event? And that's what seems to be the case here in accordance to their valuation as well. But look, we're back at the support levels here at 30.35. This is where I wanted to get in at regardless. So let's see if we can hold some support there. We get in on Cciv, Tesla. We're still down. The move yesterday was to take profits. When we had profits here, did I think it would have pulled on back, even gapped down today? Absolutely not. I didn't think that would have happened. But see how SPY's at. SPY's at 384. So if we pull back to like 370, 375 around this territory, I think that's a pretty decent pullback. You think people are going to buy in today or going to be a sell-off? I think both. I think people are still selling off. Even Tesla, like people are still selling Tesla. It's not holding its pre-market level at 680. This is insane. We held our 15 shares. I'm glad I unloaded 5 just to play it safe. Is this the market crash? I don't think so. I think correction is like 10% and crash is, I think, 30%. But we've been talking about NQ. I've been talking about Tesla as well. Be very careful. I took the risk. I said, fuck it. I'm going to take the risk. I'm going to swing trade it. So that's what happened. I was willing to take that risk. We had our shaded gray area, the correction area, the support levels where we could bounce off of, and look how fast we're headed towards that. But keep in mind, someone told me, you guys remember last year what happened? When the market pulled back? People were telling me that I was speculating that the same thing could happen around the same dates. And they're like, no, you're crazy. That's the stupidest reason why. But on February 27 of last year is when we started pulling back. And it's already February 23. And you guys remember what happened mid-March last year. So just be very careful. This is way more than 10%. Every stock is horribly dumb. And the thing is, it's just the panic continues and people just continue on selling. So watch Anki today. Let's see if we could possibly get a double bottom if we reach these lower levels here. So last time we were here was late January, early February. How's Apple doing? Apple's also pulling back under 4 hour. Let's see if Apple could bounce off of like 120 on here. PLTR. Let's see. It was around 28 yesterday. Now looks like we're coming back down to 24 on PLTR. Thinking Tesla is near the bottom now. Hopefully, that's all I can say. Some support level exactly right here at the 650. Yesterday we were talking about the 750s up here, and look how fast we came down under on that one candle itself, with all the stop losses getting set off at 750. And it tried to hold the 740s, and then again it started dumping, breaking past that 735 resistance, descending triangle. People don't want to swing it. All this market crash speculation, they're going to sell, and it caused another dump, and the panic set out pre-market with it gapping down even more, and it bounced off the 650 resistance. So I think we come down at market open and test 650s. Anything under 650, let me see. Look at that 1 hour, 4 hours, also looking very, very ugly. The next level of support we have around in the 650 area would be, I don't want to say low 600s. It's a bit spooky, but it's like low 600s, man. So this is the next trading range. We're under the SMA on the 4 hour. On our long-term trend, hopefully nothing under 550. Yeah, Neo's gonna follow. Anything's gonna be down. And the EV, like Neo, Xpeng's another one, also pulling back. Is Cciv a buy right now? I'm trying to get in within this range here today. Couple shares within this range. We also had some Walmart. We bought some Walmart yesterday, guys, or a couple of days ago, at an average price of 139. We're still down a couple bucks on that today. I think it could also come down a little bit more. That's why I didn't size in completely. The last support level we had was around 134 back in September, mid-September. So it's still under the EMA here on the 4 hour. We were also eyeing Alibaba, guys, which gapped down, or which is pulling back. Let me see. yeah, we're still it's still having a pullback. So sometimes it's not the best to always jump in on the first day it gaps down, because look, there's more continued sell off. So this is another one I'm interested. Because remember, look, always look back at the history. Look at the previous time we gapped down. We immediately started bouncing up. Let's see. We go live in what, 7 minutes? Market open in 7 minutes. AMC kind of pushing 698. Yesterday I said hopefully we hold above 6. Hopefully we close above 6. Headed into earnings, baby. That's something to be excited about. I am neck deep in PLTR and I'm shitting myself. It's not necessarily the best to go deep in on any stock, bro. That's the same reason why. It makes you uncomfortable. Anything that tends to start to make you uncomfortable position wise, don't do it. Like I've done this before. I can't sleep at night. I lose sleep. I'm checking my phone constantly, you know. So it's not worth that, the stress that comes with that. So AMC, hopefully we were closing above 6 yesterday, and we closed pushing into some new highs at 671. They did open their theaters in New York, by the way, and it looks like we're pushing 7. So the thing I can expect is possibly $8 before earnings. We're going to be covering earnings on Thursday after hours, so make sure you guys subscribe to the channel. Drop a like on this video if you guys are excited for earnings. Let me see. Chapstick. But yeah, also GameStop. Let's see how GameStop's doing. I don't think I've taken a look at GameStop this morning. 45 range still. We need to break out of this range. Amen. Yeah, it's not worth it, man. Any position that makes you uncomfortable, it's like, don't do it. Any stocks you guys want me to take a look at right now before market opens, drop them in the chat. Facebook app, Amazon, Netflix, Twitter. Let's take a look at Twitter. So a lot of people are now speculating that no other company is going to follow Elon Musk's footsteps in buying Bitcoin. Because look what happened to Tesla after they announced their Bitcoin 1.5 billion purchase. But also keep in mind that's a kind of a bad price here. But they're not going to follow. Also keep in mind the entire Lucid Motors thing, them coming to market. That's also going to eat away at their market share. And the whole market coming down, that's what's causing the whole Tesla drop right now. Let me see. IDED. I don't think this is a stock. It's not coming up on my screen. ZOM. I think we covered this one yesterday. I wasn't interested because like it was just barcoding. There's no volume. There really isn't any opportunity for me to catch a day trade there. Unless you're going long term. I think this was also on an uptrend on the 4 hour. Yeah, it was spiking up here. I think we have earnings on Wednesday after market. Thursday before market. So usually I love stocks before earnings because they tend to push and run. And that's exactly what we're seeing on AMC. We've seen it on Tesla. We've seen it on Apple. That's how you play earnings, in my opinion. I'm not a financial advisor though. But you play the hype headed into earnings, and usually on earnings, it dumps. And that's what I'm scared that will happen on AMC. We rally into earnings, and then we take a dump. That's what happened on Tesla. It took a dump, pushed into earnings. Apple, same thing. It dumped. So I hate to say it, but I always just keep it how I see it and keep it real. IDEX. Someone I think also mentioned this one yesterday on the 4 hour. I might be kind of interested. This one's actually pulling back on the 4 hour, getting rejected off the $5 mark. Where do we have some support? Look at this history. It doesn't hold its spikes. Spikes to like 130, pulls back. Has a multi-day runner here, pulls back, finds some support. Spikes, pulls back. Spikes, pulls back, all the way up. So it pulls. I think it could pull back to under 3. That's an alert on this guy. 3 minutes to market opens. Actually 2 minutes. How's NQ holding? Looks like we found some support, but I won't be too sold on it. Tesla is still selling off. Like I said, I think we test 650s, and if we do, it might get ugly. AGTC. pretty much been flat since like April all the way till like November. Not a lot of action going on, a lot of room for profit in my opinion. And look, it's can't hold its spikes. Spikes a 9, comes back down into within this range. I think it comes down into back to the $5 mark. That's what I think. FTX. It's not coming up. I think you meant FRX? FRX, right? Yeah, that's what you meant. I'm looking to get in FRX. I'm looking to get in some shares here, but I know this is a very risky play, and I'm willing to lose on this one. So my alert did not go off. So let's cut that here. Let's set an alert here. Yeah, FRX is one I've been watching. 45 seconds till countdown. Here we go. How's AMC pushing? 697 still. Tesla. Let's see. What are your favorite stocks currently? AMC, GameStop, Tesla. 8 seconds. I'm trying to think. CCIV, PLTRs are the ones that I'm watching. Usually I like to keep the watch list. The bell's gonna go off short, by the way. Keep a watch list short. Alright, here we go. Here comes a drop on Tesla. Think it's gonna come down. Is it? We'll see. NQ needs to literally break above this resistance level here. I don't think we can afford to pull back any further. We need to see some signs of momentum up. Why do you leave for 2 years? Other business, man. I got very busy and just it was too much time. And this is like my first time streaming actual stocks. Alright, let's set our alerts. Should we add more, guys? What do you guys think? Should we add more to our position? MVIS was one that I was watching as well. Interesting. Let's see what we're doing. What's going on here? Microvision. Okay, I went down on this one. This is another one that I also wanted to come down. Has earnings, so interesting. AMC, how we doing? 698. Let's have our alert. Once we break above. PLTR, CCIV. Oh, CCIV is still pulling back. Okay, let's see if we could get in on here. So the last level of support was right around 30. 32, let's get in. No explanation. Car rental business, basically. If you know anybody who owns a car rental business or works at a car rental business, it's the most stressful business in the world, man. Let's see. Let's get in 5 shares on CCIV. Do I get filled? And I'm not getting filled. Okay, here's the thing with TD Ameritrade. It will not fill you in, but I think it's gonna fill me in a couple minutes from now. Alibaba, right? That was the alert that we got right now. Alibaba. Oh, that's because it gapped down. Tesla. Pulling back. Oh, it's pushing a bit. It's pushing. So we're in from 732. We have 15 shares at 732, and we're down $1,300. Again, I just lost $1,300 on Tesla last week. But you don't lose until you sell. So I'm gonna be holding these shares. I think I have not that bad of a price. NQ, are we pushing or are we holding? Not looking too strong. Apple, GME, pushing on GameStop. That's good. Oh no, my alert didn't go off. AMC's at 749. Guys, I've been talking about this. It's nice to see this happening. Look, I've been talking about cup and handle forming, breaking past that EMA here. We've gone rejected. We found some support. We had some slight indications that we were gonna break out. 665 rejected. A couple days after. 654 rejected. This is the day they had the 2 million hashtag 2 million Tuesday. Got rejected as well, and now we're pushing. My price target is still the same, $8 and then $10. And nope, there we go. CCIV, I got filled in. delayed, but still at the price I wanted, right? Or we still dropping? Yep, we're up $6 on that one. AMC. Let's go, AMC. GameStop. PLTR. Pulling back. Let's see. Let's see if we pull back even more on CCIV. I think we might pull back on this one a little bit more. It's getting rejected here on the EMA. Look, it's not pushing. Looks like people are still dumping. AMC gang, where you at? Oh, look, NQ, man. It's not looking good. Is Tesla falling NQ? Yeah, it is. It's not good. You guys think we break down under? I think we break down under right now. Yep, we're breaking down. Man, new low. So how much further can we drop? This next support line here. Let's set our alert. Apple. Oh, Neo's also taking a dump this morning. Do you think I should buy AMC today? I think the play for AMC, I mean, you can still get in. I think $7 is pretty fair, but it was 5 right around here, support level. The $5 mark. It's like now you're buying a little bit higher. Oh, CCIVs are actually pushing. Interesting. So let's see if we could get a reversal. Let's see where the EMA is on the 5-minute. EMA on the 5-minute is at 35.90. Let's call it 36. So let's see if we could get a push back to 36, which is that pre-market level right here. XPEV falling. It's probably following Tesla on the way down. There it is. Tesla tested 650s. Are we going to break down? That's going to be an interesting drop here if we do. I said a limit buy for 690 in the case if it drops, in case it drops some more, right? So what's today? Tuesday, right? So Thursday after hours are the earnings. So I think we could see some more momentum up. So I don't think that's a bad play. Oh, GME is tanking. It's no bueno, not good. Yesterday low was 42.40. It looks like we're coming down to retest that. That was a 1 hour. The 1 hour low here we had was a 38.50. I don't think we can afford to drop any further than that, honestly. It could get real ugly if it drops under that. This is one that got rejected off EMA. It's struggling to find some support. We need a catalyst to send GME up. Ah, Tesla. New low, 646. That's the worst part about days that come down like this. You just don't know where the bottom is going to be at. You just got to hold. I'm going to hold. I'm probably going to even add more. NQ, still probably dropping. Yep. New low on as we speak. On NQ. See how it's not good. PLTR, have my alert say here. AMC's pulling back. Well, you had your limit at what, 690, right? You must have got filled in. Pulling back. So I think a win today on AMC would be if it closes above 7. Might be a little difficult today with the whole entire market pulling back, but if AMC pulls it off, I'll be surprised. Let's see, BL and K. Blink charging awarded statewide charging grant across Vermont. See, this one's also interesting. It's way oversold under the EMA, 41.58. We're at $34. I'm interested. Let's see. Tesla falls 7.8% at open, erasing its year-to-date gains. Lucid Motors CEO says only we and Tesla recognize it is a tech race. Neo enters chat. It's probably still pulling back. 41.66 on the low. I wanted to buy Neo at 37 or 35 back then when it was around here before I had this massive rally. Look at the 4-hour, man. And it has earnings on March 1st. I'm actually a little interested on Neo. Tesla new low still. We are down still on this one. Let's try to day trade Tesla. Let's see if we could pull off a day trade. Make some of that money back. Let's see. Should I watch NQ or is it still going to pull back? Let's buy 15 shares. Let's go. 638.88 fill. Are you kidding me? That was a horrible fill, man. It's a horrible fill. We have 30 shares at an average price of $6.85. I might get clapped on those 15 shares I just bought. We'll see. Yep. 631. The sell-off continues, guys. So I'm trying to play the bounce here on those 15 shares. Even just like yesterday, we dropped from like 760s, cracked 750s, bounced off 735 all the way to 750, and then still got rejected. So 628. I said, let's not see 600 today, guys. It could get real bloody. It could get real bloody. Let's see. Lucid Motors CEO says valuation is reflection of our technology on CNBC. Let's see what other news we got. PLTR and 3M expand relationship to build dynamic supply chain. Pushing on CCIV. We got a couple gains right there. PLTR is dropping. Why is my alert not going off? Glitchy thinkorswim. 20. It's gonna come down to retest 2450, which was that low here yesterday, or I mean on Thursday. NQ still dropping, but it looks like it found some support. It wants to bounce. Are we going to bounce, or are we still going to keep on bleeding? AMC actually dipped down to $6, which was the price we wanted to hold yesterday. Looks like I think people took some profits here, honestly. People who bought in 7 before probably wanted to get out. What kind of news we got? AMC's New York reopening may meaningfully boost H1 results. How's GameStop? I kind of have a feeling if I open up GameStop, it's going to be dropping. 41.50. Tesla actually bounced. That was a dip buy opportunity at 627. Now we're back to break even on those shares, I think. We got filled in at 638, which was bad. It's trying to follow NQ on a bounce. Nope, looking weak. So here we are on the 4 hour. We're testing that previous support level. I don't want to see anything under than that, honestly. I don't want to see anything under than that. Are we going to bounce? Where's the EMA on the 5 minute? EMA on the 5 minute, it's at 661. Well, it's pretty strong bounce so far. Let's see if we can see a green candle on the 5 minute. So what did we buy in at, guys? We bought in at 638, right? Those 15 shares on Tesla. 638.80, something like that. So let's wait. Let's see. Apple. Oh my god, it's not looking good. I need to sell those shares ASAP. Get rid of those 15 shares. Market is not looking good at all. Failed breakout bounce. Did we get filled in? What did we get filled? We sold only 2 shares. Are you kidding me? Let's see. Still dropping. No bueno. So what can be the next low on Tesla? I said it, I don't want to see it, but it can be $600. On the 4 hour, it just completely got obliterated. Can there be a bounce in the next couple of days? Possibly. I think we have Powell speaking today, if I'm not mistaken. So hopefully he pushes the market up. Oh, man, people are just dumping Tesla. Breaking news, guys. Robinhood to restrict selling of stocks and allow only buy orders today. Wait, is this a joke? This has to be a joke, right? I don't believe it. I'm not buying it. People are panicking. Nasdaq 100 down on the year. Are you gonna bounce Tesla? Come on, let's get a bounce. Let's get a bounce. Every bounce has been failed. Oh my god, NQ is still dropping. Holy shit. And Tesla's about to pull back even more. Shall we hold these 28 shares? My gut says yes, because look how oversold this is. We can't see a bounce, but the thing is, you don't know how further it can drop. And 600 is not far away. Let's see. Let's take a look at AMC. Tesla is trending on Twitter. Guess what else is trending on Twitter, guys? Hashtag buy the dip. I think that's funny. Jimmy pulling back. Damn. PLTR, CCIV. Are we in the clear on CCIV? Nope. We're coming back down still on this one. FRX. Still coming down. I was down 19%. Yes. Oh, Powell is speaking today and tomorrow. Yeah, he's speaking today. Jennifer says the whole market is crashing. I don't. It's crashing. I guess I could say it's a crash. It's pulling back. It's panicking. People are panicking. Vader, I was down 19% yesterday. Now, IMY portfolio is down 32%. Great start to the day. Yeah, pretty much. I think everyone's down. Honestly, we're all losing money together. So don't feel bad. I'm down 2,000 since I opened that position on Tesla yesterday. With 1,300 yesterday, so I've lost $3,300 on Tesla in like less than 2 weeks. Alfredo down 26K since last week. It's been crazy, man. I feel for you. At least we're holding a bounce here on Tesla. That's the scary part about buying the dip. Sam Hyde says E-Trade is also AMC is listed at 77.20 a share. I've tried E-Trade. I don't like it. Honestly, I think Thinkorswim or TD Ameritrade is your best alternative. Inside EV said pricing structure Tesla bankrupt. I'm not sure what you mean by that, honestly. This bounce is not getting ate up on Tesla. Weak bounces. Horrible. Look, still under EMA on the 1 minute. So what are we in at? 682 average. So literally Tesla has to skyrocket all the way up here for us to break even. Jennifer says, would you pull out and take the L or hold? I'm gonna hold my Tesla. I mean, the scary part is, as you can see here, we don't know how much lower it can go. Regardless of whatever stock you're trading, you don't know how much lower it can go. I like playing off the whole numbers. So like we mentioned earlier, 600 is the next whole number for Tesla. And on the 4 hour, it's already gotten completely obliterated. And 600 seems to be like that. It was that November resistance here before we had some small push up. So $600. The thing at the back of my head is Tesla can rebound as hard as it drops. Like Tesla's a tank. Tesla's a monster. That's the thing. But there's a lot of uncertainty going on right now. A lot of uncertainty. FUD, a lot of FUD. So pull out or hold. I'm gonna hold. I'm gonna hold. I ain't taking no other L, baby. I'm gonna diamond hands this. I'm not taking an L. I took an L last week. I am not taking a $2,000 L. I'm looking for long-term investment index funds for retirement. I have that as well. I'm going long-term. When would be a good time to buy for index funds? That's the thing too. So I've always had this idea that I didn't want to buy at these highs, right? Oh shoot, SPY's tanking. So perfect example. Look at these pullbacks. You had these pullbacks, right? And they're completely recovered. Pulled back, recovered, and you're just like, man, I don't want to buy at the high. But there's a quote, there's a saying that says time in the market versus timing the market. Time in the market beats timing. So you don't always want to time it. You don't want to time the bottoms, the dips. You just want to buy whatever price you can and just hold long term. So, and it's hard, man. It's hard buying at the top. It's hard. It's hard for me. Plan crash, big suits suck. Even on CCIV, guys, I think yesterday this was like big institution, big buyers, big boys selling. I don't think a lot of people have access to after hours, especially like Robinhood traders that bought this. They can't sell after hours. I think they manipulated this down here. They took profits and they're buying back here again. That's what I think. Be greedy when others are fearful. Exactly. That's basically my strategy, Brian. Buying the dips. Buying when people are literally shitting themselves and dumping everything. I mean, look at the people who sold their stocks last March. We recovered then. Since then, we've recovered and hit new highs since then. So the market always recovers, and it's just times like these when everyone's panicking, and you just have to take the initiative and be like, you know what, I'm gonna stand out from the crowd and buy. So, is this the market crash a lot of people were talking about previously? I think so. Yeah, I even made a video on Tesla saying why I think it could drop, and now it's bouncing. Look, we're back to break even on our 15 shares. So we made a video when it was like at 700, and there was just too many variables, too many factors that played on the downside. It was just too much risk. It didn't make sense for me to buy at 794. The whole Bitcoin investment, the whole market. There was already like an aurora around the market crash too as well. Overbought levels, and I said this earlier, but I got called crazy for saying that. Who knows, man? The market could repeat what it did last year, and they were like, "You're stupid. It's because of the Rona last year. That's why it pulled back last year. We're past that." I'm like, no. I'm like, you have to understand how people think. If I'm thinking that way, what makes me think that somebody else is not thinking that way, right? Like the market pulled back last year on February 27th. I remember that day. It pulled back like insane during like this week, the 20th to the 27th, and then we had the next drop mid-March. So can't you believe? Wouldn't it make sense that people can be speculating another drop like that? Am I crazy for thinking that or no? So here we have Tesla at 640, had another bounce. On the 5-minute, like I said, we're playing that 5-minute bounce here on our 15 shares. So we're up like what, $2 on our 15 shares, possibly even $30, but we're still down crazy on our 15 shares we had initially. AMC, how we doing? Small bounce, let's go. NQ possibly bouncing. There we go. That's what I love to see. We're back at this at support level we broke down. Big suits are trying to destroy Elon's credibility. Yeah, Elon's been fighting the shorts. Why do you think he was on our side on the GameStop situation? They've been shorting Tesla forever. They hate Elon. I love Elon. Tesla calls now or wait it out. I have shares. I've got burned. I've lost so much money. Like you guys on options. It's not for me. I didn't understand the risk that was coming with it. But yeah, options could be very, very speculative. Lucrative actually. Today is how market crash looks like, right? I wouldn't call this a crash. I mean, yesterday we pulled back as well. So this is day number 2 that we pulled back. So I don't think it's a crash just yet. I think it's a small correction. I mean, just looking at the NQ support level, look at this. Look, last time we pulled back from this level to this level, I don't think it was a crash. I think it was a small retracement correction. So this time we're doing the same. Look at the previous times we pulled back. The thing is the time span, the time frame. You don't know how much more we can pull back. That's the only thing that scares me. Brian Berrigan, first time. I don't understand what you mean by that, first time. Vader says, if I had any capital to invest, I would put a lot into Tesla right now. This looks like a perfect buying opportunity right now. Yeah. I think it's very cheap right now. And I think I can expect a rebound off these support levels here. So that's what I'm playing. That's what I'm still holding. And that's why I kind of waited out. I didn't chase it up here. But for the people who bought up here and held, that they're in a tough situation right now. Support Tesla, bye, because he supports us. I love Tesla. Tesla's my favorite stock. I love the stock. It's my favorite stock. It blessed me in December, January. Made good profits on that, but it kind of sucks that we're kind of giving back some of that money now. But we don't lose until we sell, right? That bounce is still going, 644. So what are we up on our 15 shares? 6 times 15, a couple bucks. So that's what I like to do. I like to day trade if I'm down to make back some of that money that I'm losing. MVIS, this alert keeps going off. Oh no. CCIV, are we up on this one? Or are we down? Slightly on this one. Slightly break even. PLTR trying to bounce. Looks like things are trying to bounce right now. So if SPY goes down 10% over the next week, still correction. If we end up going 20% in a week or two, then yes, crash. Yeah, that's what I think. But like I said, you nailed it right. The time frame. Did you take any profits on Tesla? Nope, man. Guys, for those of you that just joined today, first, welcome. Make sure you guys subscribe because this week's gonna be insane. We have our AMC earnings. We're gonna cover that and live stream it on Thursday after hours. We have Powell. We have the next Congressional hearing. So we're gonna be live streaming all of that. We live stream here free Monday through Friday. I share all of my trades, my thoughts. You can ask me anything about tickers. I'll cover them. Tesla bouncing at 646. So we were up yesterday, guys. On Tesla, we had some profits as it spiked here to 750. We were up a couple $100. But I said, you know what? I'm not gonna sell. So I didn't take any profits. I looked at my portfolio before the market closed and I was already down, and I kind of had a feeling that we could have pulled back more today. Did I think we were going to go to 619? Absolutely not. So I didn't take any profits on Tesla. I even added more, so now we have 28 shares. I tried to partially sell my shares here and take a loss on those, but look, they didn't fill me. It was meant for a good reason. Now we're up a bit. So, or did you hold throughout the day? Yeah, I held. Good morning, Tammy. Good morning. Think it's a correction today. Yeah, I don't think it's a crash. I think it's a small correction. I just loaded up on some fire on my positions right now. Fire sale, baby. It's a fire sale going on. Hopefully that's an old alert on NQ. Hopefully it's an old alert and we're not dropping. Yep, we're bouncing. It's an old alert. Sometimes I don't think something scares me like that. But yeah, fire sale going on. I added a little bit on my Tesla. Now we're averaging 28 shares at 682. Look at that bounce here, guys. This is where the money's at. If you're a day trader and you could catch this bounce here at 619, imagine selling at 649. Do the math. That's what I was doing the entire month last month, just catching the dips. I usually don't swing trade, guys, and I've been losing in swing trading. So that kind of tells me stick to what I know, stick to what you're good at. Every time I've lost on Tesla, I've swung traded. Swung traded. Yeah, I've held it overnight. So I think that's not my best strategy, but look, we're bouncing here. Let's go, Tesla 651. Let's get a rebound. Let's see how AMC is doing. Are we above 7? 676. GameStop, please don't tell me we're dropping. Let's get a rebound on there. 643. 43. CCIV pushing. CCIV pushing. Come on, let's go. PLTR pushing. See, I hate those old alerts. Apple, let's get a bounce on that. Facebook also probably pushing. Amazon, kind of flat. I've been eyeing Amazon for a while now. It's almost back at the support level. I have my alert here just in case we drop under this level, 3,000. I'll be interested. Just how we doing? 649. Oh, Powell's live actually. Oh, 7 a.m. right? 1 minute. Tesla is made of flubber. No matter how hard it falls, it always bounces back. Yeah, that's one thing I've learned. Just look at this 654 spike. Yeah, I'm sorry if I mispronounced your name. Junaid? Powell's going live right now. The chat on there is going crazy. So hopefully Powell pumps the market. I think that's what we're seeing right now. He's basically probably going to say the printer is still... Oh, the stream is lagging. Let's see. Is it lagging for you guys? 654. My last comment in there. CTRX. What about CTRX? Oh, CTXR. I'm sorry. For 1 hour, 4 hour. I'm not like too appealed about this stock. Even just the chart pattern alone, I don't see a play. Can't really hold its gains, so I don't think there's a lot of room for profit for me on this side of the way. Compared to like Tesla, look at that bounce here. It's still pushing, guys. So we were down 2,000, now we're only down 1,100. BLNK. The BLNK is another one I was interested. Even just wait, that was an old alert. But even just comparing it to the stock you pulled up or recommended, I buy on dips, guys. So I like buying when things are way oversold. Another example, Alibaba, which we're gonna hop in soon. Walmart, which we did hop in, and look, it's still dropping. Walmart is still dropping. My next level of support, that's why I didn't buy too many shares, was exactly where we're at, 135. And it did come down. It had a failed breakout. So let's see if we can add 5 more shares on Walmart. We bought 5 more shares here on Walmart. See how NQ's doing. NQ's bouncing. We're waiting for Powell, Tesla. I kind of want to unload those 15 shares. Let's unload 8 shares. All right, we sold 8 here. We're still holding 20.
Is resolved. To simplify the speaking order process, Senator Toomey and I agreed to go by seniority for this hearing, as we have in the past. Simplify the speaking order process. At this committee's first hearing, we heard from our witnesses the challenges and seniority for this hearing, as we have in the past. At this committee's first hearing, we heard from our witnesses the challenges and struggles Americans have faced over the past year. Anyone who's been doing their jobs has heard these stories. Frontline workers like transit workers, whom we heard from last week, go to work every day worried they'll get the virus on the job and bring it home to their families. Mayors and county commissioners, community leaders wonder how long they can hold on without starting layoffs. Renters see their bills pile up, watching their bank balances dwindle lower and lower, wondering if this will be the month that an eviction notice is posted on their door. Today, more than 4 million people are out of a job. That number keeps climbing. We are still fighting the battle against the coronavirus. Nearly 500,000 of our fellow Americans have died from COVID-19. We know we're facing 2 crises, a public health crisis and an economic crisis. We have to be clear about that. We can't solve one without solving the other. We know getting our economy back to full strength requires a massive wartime level mobilization to get all Americans vaccinated. We also know that vaccines alone will not put most workers and their families back to where they were a year ago. We want people back to work. We want kids back in school. We want to see Main streets thriving and humming with life again. That requires real federal leadership on a level we've not seen in this country since World War II. As Bill Spriggs alluded to in testifying before this committee, before D-Day, General Eisenhower didn't call President Roosevelt and ask, can we afford to storm the beaches at Normandy? Do we have the money in our accounts? Most people that I talk to in Ohio and around the country are not worried about doing too much in the battle against this virus. They're worried about doing too little. They want to do whatever it takes. 85% of Americans still need a vaccine. Our frontline workers still need PPE. Small businesses still need assistance to keep their doors open. States and cities and towns still need resources and support to open schools safely and keep buses running and libraries open and firefighters on the job. Experts agree the best thing we can do for the country right now is to get resources out the door as quickly as possible to tackle these interconnected problems. Former Fed Chair, now our Treasury Secretary, Janet Yellen, said if we don't do more, we risk a permanent, her words, scarring of the economy into the future. Economists from across the political spectrum, include many who have testified before this committee, tell us that without strong fiscal support, our economy could spiral even further out of control and take even longer, years to recover. Our witness today, Federal Reserve Board Chair Jerome Powell, has expressed some of those same concerns. Just a few weeks ago, after we passed the COVID-19 relief bill in December, Chair Powell said that, quote, support from fiscal policy will help households and businesses weather the downturn as well as limit lasting damage to the economy that could otherwise impede the recovery. Chair Powell has talked to all of us about the risk of falling short of a complete recovery, the damage it will do to people's lives and to the productive capacity of this economy. Those were his words, productive capacity of this economy. President Biden understands this moment. He's risen to meet it with his bold American Rescue Package. It's a plan to both rescue the economy and save American lives. Workers and their families need to see their government work for them now. And this rescue plan must be the beginning of our work to deliver the results that empower people and make their lives better. We need to rethink how our economy operates when a hard day's work doesn't pay the bills for tens and tens of millions of workers, and even middle-class families don't feel stable. Something in the system's broken. We know that. Workers' wages have been stagnant for decades. CEO pay has soared. Corporations get huge tax breaks. Instead of investing in their employees and the communities they serve, management too often rewards itself and its shareholders through stock buybacks and dividends. The wealth and income gaps for women and for Black and brown workers are getting worse, not better. Many families still had not recovered from the Great Recession when the pandemic hit. This didn't happen by accident. It's the result of choices made by corporations and their loyal allies in Washington. They spent years rolling back consumer protections in our financial system, cutting corporate tax rates, using Wall Street to measure the economy instead of the condition of workers. And the same people that have been advocating for these rollbacks, pushing this stock market-centered view of the economy, are the same people who say we should not go big on a rescue plan. They say there's no need for the government to help people, that the market should decide who wins and who loses. We all know the market doesn't work when the game is rigged. Corporations have been lining their own pockets, have done so with plenty of government help and intervention. We know that for them, short-term profits are more important too often than their workers. That's why we have to stop letting them run things. Look what's happened in Texas, where a deregulated energy grid failed, leaving millions without power in frigid winter temperatures. People are literally freezing to death in their own homes in the United States of America. Without any rules, energy companies can charge consumers sky-high prices. They even use automatic debits, taking thousands of dollars directly out of people's bank accounts. We know climate change causes severe weather patterns across this country. We know more investment in public infrastructure, not less. We need more, not less. We can't let corporate greed continue to stand in the way. Our nation's central bank plays a critical role in all of this. The Federal Reserve can ensure the biggest banks use their capital to invest in their workers and lend in their communities instead of ginning up stock prices with buybacks and dividends. The Fed can make sure the response to economic and financial crises doesn't just help Wall Street, it helps everyone. It can require that financial institutions take into account the serious risk posed by climate crisis. It can help ensure that everyone in this country has a bank account and access to their own hard-earned money. It can start to undo the systemic racism in the financial system, from black codes to Jim Crow to redlining to locking in discriminatory practices during the last administration. It can make workers the central focus of our economy. Chair Powell, you said just a few weeks ago, quote, "The benefits of investing in our nation's workforce are immense. Steady employment provides more than a regular paycheck. It bestows a sense of purpose. It improves mental health, increases lifespans, benefits workers and their families." Unquote from the chair. What that boils down to is the dignity of work. It means hard work should pay off no matter who you are, no matter what kind of work you do, whether you punch a clock or work for tips or work on a salary or taking care of aging parents. It means we need to start measuring success of our community by the success of the people who make our economy work. Chair Powell, thank you. I look forward to your testimony. Senator Toomey.
Thank you, Mr. Chairman, and thank you, Chairman Powell. Welcome back to the Banking Committee. I look forward to your testimony. About a year ago, the U.S. economy was entering an unprecedented economic contraction as a result of the shutdowns that followed the spread of COVID-19. We all remember credit markets seizing up. Second quarter GDP last year fell by over 30%. Unemployment rate reached about 15% in April, the highest it had been since the 1930s. The economy was in very desperate straits, to say the least. Thankfully, the worries about a long, drawn-out depression appear to have been unfounded. In response to the economic collapse, Congress and the Fed took very, very bold, unprecedented, and decisive action. The Fed quickly lowered interest rates, launched a quantitative easing program on unprecedented scale, and helped facilitate market functioning through a variety of emergency programs that were funded through congressional legislation. And we in Congress passed over $4 trillion in relief over 5 overwhelmingly bipartisan bills. Fortunately, today, we are in nothing like the situation we were in last spring. Today, the unemployment rate is now 6.3%, about where it was in July of 2014. 18 states have unemployment rates below 5%. The average household in America is in a better financial position today than it was in before the pandemic. Personal savings rates are up by over $1.6 trillion. Consumer credit is down by over $100 billion. There's no question there are some subsets of our economy and our society that have been hit much harder than others. But in the aggregate, the fact is Americans have more disposable income now than they had before the crisis. And yet, Congress is in deliberations to spend another $1.9 trillion with universal payments to people who've never had as much income as they do, to entities that have such as state and local governments, which in the aggregate have taken in more revenue in 2020 than they did ever before. We are well past the point where our economy is collapsing. And in fact, our economy is growing very powerfully. The last thing we need is a massive multi-trillion-dollar universal spending bill. And we should recognize that all of this spending comes at a cost. It all gets funded with government debt, which is either monetized, which has its own dangers, or it's a burden that gets passed on to future generations that have to service that debt. In 2020, debt held by the public reached 100% of our total economic output, and CBO projects that over the next 10 years, net interest costs will amount to $4.5 trillion, and that's without another $1.9 trillion bill. There's also a real danger that we have overheating in places that lead to unwanted inflation, and I think the data is increasingly pointing in that direction. Keep in mind, we have $11 trillion in personal saving deposits. The country is in an accelerating reopening as the number of COVID cases is declining very, very rapidly on a daily basis. The economy is poised for very substantial growth in the near term, and yet the Fed continues to purchase $120 billion of securities per month, maintain short-term interest rates at basically zero. And Congress is considering, as I said, another enormous bill. And another matter, I want to make the point that I do think it's very important for the Fed to continue focused on the mandate it has and not to seek to broaden that mandate. As noble as the goals might be, issues such as climate change and racial inequality are simply not the purview of our central bank. So during this hearing, I look forward to hearing about your views, Mr. Chairman, on the economy, on monetary policy, and the state of our markets. And with that, I yield.
Thank you, Senator Toomey. Today, we'll hear from Federal Reserve Chair Jerome Powell, the Fed's monetary policy and the state of the U.S. economy. It's nearly 1 year since the coronavirus pandemic first wreaked havoc in our country. We know the Federal Reserve plays a key role in making sure that our economy recovers for all Americans. Chair Powell, thank you for your service. Thank you for being in front of our committee today and for your testimony. Proceed.
Thank you and good morning. Chairman Brown, Ranking Member Toomey, and other members of the committee, I'm pleased to present the Federal Reserve's semi-annual monetary policy report. At the Federal Reserve, we are strongly committed to achieving the monetary policy goals that Congress has given us: maximum employment and price stability. Since the beginning of the pandemic, we've taken forceful actions to provide support and stability, to ensure that the recovery will be as strong as possible, and to limit lasting damage to households, businesses, and communities. Today, I will review the current economic situation before turning to monetary policy. The path of the economy continues to depend significantly on the course of the virus and the measures undertaken to control its spread. The resurgence in COVID-19 cases, hospitalizations, and deaths in recent months is causing great hardship for millions of Americans and is weighing on economic activity and job creation. Following a sharp rebound in economic activity last summer, momentum slowed substantially, with the weakness concentrated in the sectors most adversely affected by the resurgence of the virus. In recent weeks, the number of new cases and hospitalizations has been falling, and ongoing vaccinations offer hope for a return to more normal conditions later this year. However, the economic recovery remains uneven and far from complete, and the path ahead is highly uncertain. Household spending on services remains low, especially in sectors that typically require people to gather closely, including leisure and hospitality. In contrast, household spending on goods picked up encouragingly in January after moderating late last year. The housing sector has more than fully recovered from the downturn, while business investment and manufacturing production have also picked up. The overall recovery in economic activity since last spring is due in part to unprecedented fiscal and monetary actions, which have provided essential support to many households, businesses, and communities. As with overall economic activity, the pace of improvement in the labor market has slowed. Over the 3 months ending in January, employment rose at an average monthly rate of only 29,000. Continued progress in many industries has been tempered by significant losses in industries such as leisure and hospitality, where the resurgence in the virus and increased social distancing have weighed further on activity. The unemployment rate remained elevated at 6.3% in January, and participation in the labor market is notably below pre-pandemic levels. Although there has been much progress in the labor market since the spring, millions of Americans remain out of work. As discussed in the February monetary policy report, the economic downturn has not fallen equally on all Americans, and those least able to shoulder the burden has been hardest hit. In particular, the high level of joblessness has been especially severe for lower wage workers and for African Americans, Hispanics, and other minority groups. The economic dislocation has upended many lives and created great uncertainty about the future. The pandemic has also left a significant imprint on inflation. Following large declines in the spring, consumer prices partially rebounded over the rest of last year. However, for some of the sectors that have been most adversely affected by the pandemic, prices remain particularly soft. Overall, on a 12-month basis, inflation remains below our 2% longer run objective. While we should not underestimate the challenges we currently face, developments point to an improved outlook for later this year. In particular, ongoing progress in vaccinations should help speed the return to normal activities. In the meantime, we should continue to follow the advice of health experts to observe social distancing measures and wear masks. I'll turn now to monetary policy. In the second half of the year, the Federal Open Market Committee completed our first ever public review of our monetary policy strategy, tools, and communication practices. We undertook this review because the U.S. economy has changed in ways that matter for monetary policy. The review's purpose was to identify improvements to our policy framework that could enhance our ability to achieve our maximum employment and price stability objectives. The review involved extensive outreach to a broad range of people and groups, including through a series of Fed Listens events. As described in the February Monetary Policy Report, in August, the committee unanimously adopted its revised statement on longer-run goals and monetary policy strategy. Our revised statement shares many features with its predecessor. For example, we have not changed our 2% longer-run inflation goal. However, we did make some key changes. Regarding our employment goal, we emphasized that maximum employment is a broad and inclusive goal. This change reflects our appreciation for the benefits of a strong labor market, particularly for low and moderate income communities. In addition, we state that our policy decisions will be informed by our assessments of shortfalls of employment from its maximum level, rather than by deviations from its maximum level. This change means that we will not tighten monetary policy solely in response to a strong labor market. Regarding our price stability goal, we state that we will seek to achieve inflation that averages 2% over time. This means that following periods when inflation has been running below 2%, appropriate monetary policy will likely aim to achieve inflation moderately above 2% for some time. With this change, we aim to keep longer-term inflation expectations well anchored at our 2% goal. Well-anchored inflation expectations enhance our ability to meet both our employment and inflation goals, particularly in the current low interest rate environment, in which our main policy tool is likely to be more frequently constrained by the lower bound. We've implemented our new framework by forcefully deploying our policy tools. As noted in our January policy statement, we expect that it will be appropriate to maintain the current accommodative target range of the federal funds rate until labor market conditions have reached levels consistent with the committee's assessment of maximum employment, and inflation has risen to 2% and is on track to moderately exceed 2% for some time. In addition, we will continue to increase our holdings of Treasury securities and agency mortgage-backed securities, at least at their current pace, until substantial further progress has been made toward our goals. These purchases and the associated increase in the Federal Reserve's balance sheet have materially eased financial conditions and are providing substantial support to the economy. The economy is a long way from our employment and inflation goals, and it is likely to take some time for substantial further progress to be achieved. We will continue to clearly communicate our assessment of progress toward our goals well in advance of any change in the pace of purchases. Since the onset of the pandemic, the Federal Reserve has been taking actions to more directly support the flow of credit in the economy, deploying our emergency lending powers to an unprecedented extent, enabled in large part by financial backing and support from Congress and the Treasury. Although the CARES Act facilities are no longer open to new activity, our other facilities remain in place. We understand that our actions affect households, businesses, and communities across the country. Everything we do is in service to our public mission. We're committed to using our full range of tools to support the economy and to help ensure that the recovery from this difficult period will be as robust as possible. Thank you. I'm happy to take your questions.
Thank you, Chair Powell. First, just a yes or no question. Do you agree the most important thing we can do for the economy right now is get people vaccinated?
I would say that yes, that is the single best policy to return the economy to its potential growth.
Thank you. The researchers in Minneapolis Fed say the pandemic is forcing mothers of young children out of the workforce. Some 3 million women have been forced out of the paid labor market in the past year. Everyday families face impossible choices between their paychecks and caring for their children. The Biden Rescue Plan, as you know, provides the funding we need to get Americans vaccinated, as you suggest is the right policy. and that will help kids go back to school, to help working moms back to work, get back to work safely. What can the Fed do to make sure women, especially those with young children, can return to the workforce so that we don't end up with an even bigger lasting gender gap in the labor market?
So the tools that can really address specific groups, for example, women who've perhaps temporarily dropped out of the labor force, those are really fiscal policy tools. Obviously, those are not tools that we have. And I today will, stay away from fiscal policy and really talk about what we can do. And I think the main thing that we can do is continue to support the economy, give it the support that it needs. We're still 10 million jobs below the level of payroll jobs before the crisis. There's still a long way to go to full recovery, and we intend to keep our policy supportive of that recovery.
Thank you for acknowledging in your opening statement and your comments to many of us and your public comments, frankly, about how much we need to do to fight racism and increase diversity. Yeah, we know historically the Fed's monetary policy has benefited wealthy savers and homeowners. Decades of discrimination in the financial system, we talked about earlier, from redlining to the subprime mortgage crisis, specifically targeted Black, brown, and other vulnerable communities. It's clear the Fed's policy and failure to regulate predatory actions in the banking sector have contributed to the racial wealth, income, and home ownership gaps. You've said that the Fed's tools can't address the underlying causes of racial injustice or income and wealth inequality in our economy. I think you give up a little too easily when you say that. So how can the Fed use its supervision authority to enforce anti-discrimination laws and fight racial injustice and income inequality?
We do have responsibilities and authorities for fair lending, for example, under a number of statutes, and we take those responsibilities very seriously, and I think carry them out robustly, and that is an important part of our mandate. And so that is something that we can do, and I think we do aggressively. In addition, through our community consumer affairs division, and through the Federal Reserve banks, we don't spend public resources, but we try to attract private resources around, for example, initiatives that will address issues of economic issues of low and moderate income communities and racial minorities.
I think we can do more, but we will discuss that later. Chair Powell, in the middle of the pandemic, bank regulators have loosened capital requirements at the biggest banks, and one of its changes to the capital rules, the Fed stated the rule was meant, and I quote, to allow banking organizations to expand their balance sheets as appropriate to continue to serve as financial intermediaries rather than to allow banking organizations to increase capital distributions, unquote. In other words, the Fed reduced capital standards so banks would lend more, not so they would pay dividends. But it's, as you know, it's not what's happening. The biggest banks have gotten larger, they've gotten more profitable, but they haven't increased lending. Dividends, however, have remained steady. My question is, Mr. Chair, will you promise to the committee that you will not extend any exemptions for capital requirements for banks and bank holding companies that have continued to pay dividends rather than invest in the real economy?
So we're talking here really about the temporary measures we took with respect to the supplemental leverage ratio, and those expire at the end of March. We have not decided what to do there yet, and we're actually looking into that right now. I'm not going to commit to connecting that decision to the payment of dividends as a separate matter. As you know, we intervened to require the banks to limit their dividend growth to zero, and also to limit their share buybacks. And the result, what you see now, is a banking system that has higher capital than it did going into the pandemic, and particularly for the largest banks, and one where the banks have taken very large reserves against losses, and so have proven themselves pretty resilient.
Perhaps, but I also we also understand that they have not been supporting the real economy to the degree that we hope they would, and we will continue that conversation. And I will send a written question to you on climate that we wanted to talk about. Senator Toomey.
Thank you, Mr. Chairman. Just on this topic, let me just state, I certainly hope that to the extent that banks have adequate capital for the circumstances that they face at any point in time. Any capital beyond that should absolutely be available to be returned to the people who own those banks in the form of dividends or stock buybacks or whatever mechanism is suitable. And anything to the contrary is a terrible constraint on our economy and on economic freedom. I also want to just observe briefly, and I'm not asking for a comment on this, Chairman Powell, but if I could summarize and characterize your opening comments about the economy, I think it's fair to say that we have many areas, sectors of our economy that are performing extremely well. Housing and the goods sector, I think you referred to. And then we have very concentrated problems in certain relatively narrow sectors like hospitality and travel and entertainment, which are extremely depressed because of the circumstances. I think that clearly makes a very strong case that if there were to be further fiscal policy, it should address where the problem is and not where the problem is not. But to address monetary policy for a moment or so, I think the Fed's current forecast for growth for this year is over 4%. I think the consensus is well over 5%, with some thinking it could be considerably higher than that. The unemployment rate is now at 6.3, which is about where it was in 2014 when we were not contemplating multi-trillion-dollar bills. And I don't think we were buying $120 billion worth of securities per month. My concern is that the last two recessions were, I think, caused by asset bubbles that burst. 2001, it was the stock market. 2008, it was the mortgage credit market. In both cases, in my view, monetary policy contributed a great deal to the formation of those bubbles. The Dallas Fed president, Robert Kaplan, recently acknowledged that there's a link between the record amount of liquidity being pushed into the system and these unprecedented asset valuations that we're seeing in a whole range of assets, be it GameStop or Bitcoin or real estate, commodities. Across the board, we're seeing quite elevated asset prices and signs of emerging inflation. So I guess my question is, do you believe that there is a link between the liquidity that the Fed has been providing and some of these unprecedented asset prices?
So there's certainly a link. I would say, though, that if you look at what the market is looking at, what markets are looking at, it's a reopening economy with vaccination, it's fiscal stimulus, it's highly accommodative monetary policy, it's savings accumulated on people's balance sheets, it's expectations of much higher corporate profits, which matters a lot for the equity market. So there are many factors that are contributing to what's happening in markets right now. Monetary policy, I would certainly agree, is one of them.
Yeah, I would just suggest that, right, I agree. All of those things are happening. All of those indicators of growth and increasingly indicators of rising inflation. As you know, the TIPS 10-year break even on inflation is now over 2%, up from 0.6%. My point is that at some point, we've got too much liquidity going into the system. The economy is recovering very, very well. Problems are isolated and should be addressed narrowly. And I hope that $120 billion a month of bond buying doesn't become a permanent situation. One of the things I'm concerned about, I wonder if you could comment on, the risk that we would have an increase in inflation, an increase in bond yields that would correspond to that, but without being back at full employment. What is that? What would that imply? Which I think is a very plausible scenario for later this year. What does that imply for the bond buying program?
Well, so what we've said about the bond buying program is that it will continue at the current pace, at least at the current pace, until we make substantial further progress toward our goals. And we've also said that as we monitor that progress, we'll communicate well in advance of any actual decisions, purchases. And so that's what it will take for us to begin to moderate the level of purchases. It's substantial further progress toward our goals, which we haven't really been making for the last 3 months, but expectations are that will pick up as the pandemic subsides.
Well, thank you, Mr. Chairman. I would just suggest that there are a lot of warning signs that have not been worrisome in the past, but now are certainly blinking yellow. And with that, I will yield.
Thank you, Senator Menendez.
Thank you, Mr. Chairman. Chairman Powell, at the end of this pandemic, we need to ensure that we have a more equal society. Unfortunately, we're not on a path to an equal recovery. As of January, the Black unemployment rate is 9.2%. The Hispanic unemployment rate is 8.6% compared to 5.7% for white workers. According to the New York Fed, over the course of the pandemic, the black labor force exit rate has increased dramatically, while the white labor force exit rate has returned to pre-pandemic levels. Doesn't this mean that the black unemployment rate is likely misleadingly low compared to the white rate?
Well, this, as you point out, this pandemic was particularly bad for these long-standing disparities that we have in our economy. The job losses were heavily concentrated in public-facing service sector jobs. Those tend to be more skewed towards lower-paid and in many cases minorities and women. And so that's really where the big pockets of unemployment were made. And so, and you're right. So the burden really has fallen more in the low and moderate income communities than would typically be the case. It's always the case to some extent. This particular event, though, is very somehow precisely aimed at those people, and we're well aware of that.
Well, I appreciate that acknowledgement. We know from the Bureau of Labor Statistics that over the course of 2020, the labor force participation rate for black men and women fell nearly twice as much as it did for white men and women. So you agree that minority families are bearing the brunt of the damage caused by the pandemic?
Yes, along with others at the lower end of the income spectrum, bottom quartile.
Would you agree then that addressing this disproportionate damage needs to be a central priority in relief efforts?
I would have thought so.
Yeah, so would I. Now, as part of the Federal Reserve's mission to ensure maximum employment, what's the Federal Reserve's plan for maximizing employment for low-income and minority workers?
So we look, when we say that maximum employment is a broad and inclusive goal, that means we look not just at the headline numbers, we also look at different groups, and we try to take all of that into account in making our assessment. So we will take into account the headline numbers, but also those for other groups as we think about reaching maximum employment.
Well, I hope that in your mission that the Federal Reserve looks at this, because a Federal Reserve study showed that while high-income jobs mostly recovered to pre-pandemic levels, unemployment among low-wage workers remains 14% below pre-pandemic levels. And this is in spite of the fact that almost half of all low-wage workers are essential workers, the people who actually let us stay home when we were told stay home to avoid the spread of the pandemic and to be infected, but they were risking their lives in the jobs that they did. And so I believe we have the tools and what we to try to make this an equitable recovery. So would you commit to working with Congress and the Treasury to help low-wage workers and minority workers be able to recover just as strongly as others?
We will do that. I will say, though, that monetary policy as a tool is famously it's a broadly effective tool. It doesn't enable us to target particular groups. It lifts the entire economy, but we're going to be mindful, though, of the disparities that exist as we make our decisions.
Then finally, as of February 1st, an estimated 13 million adults were not caught up on their rent. Another 10 million adults were not caught up on their mortgage payments. Our country is very clearly in the midst of a housing crisis. What would be the effect on the housing market and our overall economy if Congress doesn't provide additional resources to help families struggling to pay their rent and mortgages?
Well, if those people, if it were to get to the point at which people were evicted, then you're talking about people's lives being disrupted in ways that are sometimes quite hard to recover from, both for renters and owners. So it is important. I think the single best thing we can do about that, of course, is to keep monetary policy accommodative, to do what we can to speed the recovery so that it will be robust and complete as soon as possible.
Well, millions of people losing their homes would not only affect rateable basis and the most single aspect of wealth. So I hope you'll keep your eye on that. Thank you, Mr. Chairman.
Thank you.
Senator Shelby.
Good morning. Chairman Powell, thank you for your service of a number of years and how you, I believe, done an outstanding job as chairman of the Federal Reserve. I would like to associate myself this morning with a lot of the questions that have been asked already by Senator Toomey, the concern of inflation, the concern of the balance sheet, where's the economy going when we get over this COVID, which we all hope and pray will be sooner than later. And I'd like to add to that, Mr. Chairman, what's your view of the world economy tying into ours, because it's an important factor as we go forward, assuming in the next, say, 6 months that we get a handle around COVID in the country and Europe, for example, does the same thing.
So I'll take those one at a time. On inflation, let me say that we do expect that as the couple of things. First, as the very low readings of last March and April drop out of the 12-month calculation as we move forward this year, we expect readings on inflation to move up. That's called base effects. That'll be a temporary effect, and it won't really signal anything. More importantly, though, with all the factors we've been discussing, you could see spending pick up pretty substantially in the second half of the year. And that would be a good thing, of course, but it could also put upward pressure on prices. And I would just say that essentially it doesn't seem likely that that would result in very large increases or that they would be persistent. We've all been living in a world for a quarter of a century and more where all of the pressures were disinflationary, pushing downward on inflation. We've averaged less than 2% inflation for more than the last 25 years. Inflation dynamics do change over time, but they don't change on a dime. And so we don't really see how a burst of fiscal support or spending that doesn't last for many years would actually change those inflation dynamics. I will also say there's forecasters need to be humble and have a great deal to be humble about, frankly. But so if it does turn out that unwanted inflation pressures arise and they're persistent, then we have the tools to deal with that, and we will. Shall I continue? So on the balance sheet, we're going to continue we're at a stage where with 10 million people, payroll employment is 10 million below where it was before the pandemic. We're a long way from maximum employment. We're going to keep the balance sheet's going to continue to provide the support that we think the economy needs. Over time, the growth of it will slow, but that decision is the one that we talked about earlier, where asset purchases will continue until we make significant further progress toward our goals. You ask about the U.S. economy and the world economy. I do think, and many forecasters agree, that once we get this pandemic under control, we could be getting through this much more quickly than we had feared. And that would be terrific, but it's not done yet. The job is not done. That's the thing I keep coming back to, is we've got to finish the job with the pandemic, get it under control so that the U.S. economy can really reopen. Other countries around the world have the same set of issues. But there is, people will get vaccinated and we can get the disease under control properly. The second half of this year and thereafter, the economy could be very good, and could be good elsewhere in the world as well.
Has the fact that the savings rate has gone up tremendously in America, does that bode well in the future as far as perhaps economic activity?
So a lot of that just is that people have not been able to spend. They haven't been able to travel, go to restaurants, and that. So it's kind of forced savings in a way. So they'll spend some of that going forward. You're really thinking, I think, about the fact that the U.S. needs more savings so that it'll have more investment and more productivity. It would be nice if we had a higher savings rate, and it would be also nice if we didn't have a lot of dis-savings at the federal level. That's a lot of it is that these budget deficits require a lot of assets. Not that that's something we need to turn to again, but I think this is not the time to be thinking about that. But that time will certainly come.
Thank you, sir.
Thank you. Thank you, Senator.
Thank you, Senator Shelby. Senator Tester.
Yeah, thank you, Mr. Chairman. And I want to start by thanking Chairman Powell. I very much appreciate your frankness. I very much appreciate your fight to keep the Fed independent. I know that's been difficult over the past number of years, but you've stepped up. You certainly don't want a bunch of politicians to determine monetary policy. And so I'm glad you're at the helm. I also think that we're going to have a debate over this $1.9 trillion package in front of you on probably every damn committee that I'm on, and a bunch of others. Some of that all of it is necessary, but I do want to talk to you because everybody makes points that I go, yeah, that's a good point. And it's true. The housing market in a place like Montana is hotter than hot. It is quite frankly booming. And there's another problem that I want to talk to you a little bit about the housing thing. But there are other industries, and there are folks out there who, quite frankly, don't have the job they used to have and may never get that job back. And there are business people out there that are up against it. Some of those businesses will go broke and never reopen. Others will. I just kind of want to get your perspective on, if you were not the head of the Fed, but in the United States Senate, where would you pay most of your attention to? And because I agree, any money we spend needs to be focused where it'll do the most good. There's no doubt about that. Where is your focus? Where would your focus be? Would it be unemployment? Would it be hospitality businesses, or would it be something more global than that?
It's an interesting question. Again, maybe the grass is always greener, but so our work really relates to managing the business cycle in a way. But what I always think I would focus on is more what we call the supply side, which is really investing in things that will increase the potential growth rate of the United States economy over time and make that prosperity as broadly spread as possible. Now, so let me be more specific. It amounts to investing in people, and that means education, it means training, it means all those things. And that enables those people to take part fully in our great economy. And I really do think in a global economy, people who are able to use and benefit from technology, there's no limit on the amount of those people who can be working in the United States, because it's such a global economy. I also think it's important for businesses as well, that they have a climate where they can trust, that inflation is going to be under control and that business conditions are going to be good, and that they can invest in. And I think the federal government investing in basic science over time has produced a lot of productivity enhancing things. But more generally, Senator, I think focusing on things that will make a longer run difference to our economy is what I would do.
Okay, appreciate that. Now I want to go to housing, because I talk about Montana, but I think this is true all over. We don't have enough affordable housing. We don't have enough workforce housing. I think that short-term and long-term, by the way, this is going to be a drag on the economy. Do you see the Fed playing any role, or do you think they could have a role in increasing the amount of affordable housing that's out there? And if you do think the Fed plays a role, what would that role be?
I don't really think we do. When it comes to a set of policies like that, that's targeting, the fiscal power of the federal government to what is seen as a worthy cause. It's not really something we can do. We can combat housing discrimination and things like that in lending, but I don't think we are in a position of being able to allocate credit to worthy beneficiaries. That's really fiscal policy.
Okay, getting back to the pandemic. You've implemented a lot of monetary tools during this crisis. In your opinion, have they been sufficient? And if they have, that's the first question. Have they been sufficient?
I think they have. I think the difference really this time is that fiscal policy has really come to the table. It's made a big difference.
Moving forward, have you looked at any changes to that, to the policies, the monetary policy tools that you've used moving forward?
Not yet. I mean, we're looking into that. Of course, we'll do. Right now, our focus is on providing the economy the support it needs. We'll be turning to an evaluation of everything that happened in the crisis and answering that question.
Okay. Thank you, Mr. Chairman. Thank you, Chairman Powell.
Thank you, Senator.
Thank you, Senator Tester. Senator Scott.
Thank you, Chairman Brown, and thank you, Chair Powell, for being here with us this morning. Certainly an important time for us to engage in the conversation about the future of employment in our nation, and one of the core responsibilities of the Fed, of course, has to do with unemployment. There seems to be so few issues right now, Chairman Powell, that actually unites the left and the right. I'm always stunned in Washington when we find something that unites both sides, and frankly, the minimum wage issue is an issue that has united both Republicans and Democrats on opposing having the $15 minimum wage as a part of the COVID-19 relief package. It's good to see my friends on the left coming to the conclusion that in the middle of a pandemic that, according to the Congressional Budget Office, has already shuttered, the $15 minimum wage would shutter another 1.4 million jobs. Their earlier estimate went as high as 3.7 million jobs in the middle of a pandemic that has eliminated 10.7 million jobs. This seems to be common sense from my perspective, from the perspective of Democrats and the Congressional Budget Office. My question for you, sir, is has the Fed economists conducted research on the potential impacts of raising the minimum wage to $15 an hour?
I don't know that we've looked at that question particularly. We have great labor economists who've done a lot of work on the broad area.
Yes, sir. Are there conclusions similar to the conclusions of the Congressional Budget Office as it relates to the negative impact of raising the minimum wage during the pandemic?
Let me say, as I must, that this is a classic issue that the Fed never takes a position on, and I'm not going to take a position on it here today. It's fiscal policy. Most of the research still says that there's some trade-off between job loss and those whose wages go up. But actually, the sort of unanimity of that finding of 30 or 40 years ago is no longer in place. There's a much more nuanced understanding of it. But in any case, it's just an issue where we don't play a role or express a view. But I can share with you the research that we've done. Be happy to do that.
That would be
that our staff has done.
That would be very important, especially as you think of the Fed's responsibility as it relates to providing a sustainable economy that includes keeping unemployment as low as possible. The fact that the Fed isn't taking a position on an increase of the minimum wage that is obviously, according to the Congressional Budget Office, going to eliminate the minimum of 1.4 million jobs, I think is an important engagement from the Fed on that issue. I'll ask you a different question as it relates to the COVID relief package of $1.9 trillion. It seems to me that over the last fiscal year, we spent right around $6.5 trillion addressing the pandemic. My question for you is, as we see another $1.9 trillion on top of the 6.5 that we've already spent, what is the impact on the issue of rising inflation in excess of the Fed's longer run objective of 2%?
So, of course, as I said at the beginning, I'm not going to comment today on the proposal that you mentioned, the fiscal package that you mentioned at all. Not our role. I will say on inflation, there perhaps once was a strong connection between budget deficits and inflation. There really hasn't been lately. That doesn't mean it won't return. But again, my expectation will be that inflation will probably be a bit volatile over the next year or so, due in a significant amount to particular things to do with the pandemic. For example, we'll see a slight increase in inflation in a few months because of the base effects that I mentioned. We'll also see, perhaps, we don't know this, but We may see upward pressure on prices as the economy fully reopens, a good problem to have. I don't think that those effects should either be large or persistent. And the real reason for that is that we've had decades of well-anchored inflation expectations, meaning that we've had a very volatile economy for the last 15 years, and inflation has just kind of done what it was going to do. It didn't go up.
Thank you very much, sir. I appreciate your answer. The fact that you're unwilling and unable to answer the questions as it relates to the minimum wage, and certainly you don't want to get into the politics of the $1.9 trillion package. I don't blame you. If I were you, I wouldn't want to get into the politics of it at all, frankly. And I certainly understand your reticence to do so. I'll use my few seconds here to simply say that Congressional Budget Office, some Democrats, all Republicans, all agree that raising the minimum wage is a way to destroy jobs in an economy that is looking forward to a fragile recovery. Thank you, Chair Brown.
Thanks, Senator Scott. Senator Warner.
Thank you, Mr. Chairman, and thank you for holding this hearing. Chair Powell, it's great to see you again. Thank you for the good work you're doing. I think in response to friend Senator Tester's questions, and when you were talking about the kind of investments we ought to be making that are long-term, particularly as we're thinking about infrastructure, one of the areas, and understanding what my friend Senator Scott just said in your answer, that you don't want to weigh in on the president's most recent plan, I would like you, though, to comment.
That's not my computer, by the way, guys. That's on their end.
I believe that broadband investments fall into that category of the kind of long-term structural change we need. I would argue over the last 11 months, we've seen that broadband is a necessity. I think it is absolutely COVID related. I hope that the current package can be changed to actually include a sizable investment in broadband. As good as our 4 packages, bipartisan packages, have been to date, the broadband investment has been meager or non-existent. Experts like Tom Wheeler and Blair Lemon have said somewhere in the $40 to $50 billion range, we could get about 97% coverage along with better affordability. So I guess I'm asking, would you agree that immediate efforts to close the broadband gap not only represent long-term investments, but also have some direct relationship to the current healthcare crisis?
So as you and I have discussed on a number of occasions, I would agree that broadband is kind of a classic 21st century infrastructure, and one of those things that can support growth. But I of course, don't want to go anywhere near the question of what should be included in the package. If that's okay.
What about the question, though, from a macroeconomic standpoint, broadband and trying to close the digital divide, if we're going to have a fulsome recovery across all socioeconomic groups, could you speak to the question of the necessity for broadband to be ubiquitous if we're going to have that kind of robust recovery, and comments about whether broadband is at this point, a nice to have or an economic necessity, whether it's telework, telehealth, or teleeducation?
No, so again, as you and I have discussed on a number of occasions, I would agree that it is a classic piece of infrastructure for the modern economy, for the service economy, for the technologically advanced economy, and having it broadly available just could mean as broadly available as possible could be a significant benefit, economic benefit.
If not broadly available, are we going to be able to see the kind of broad-based recovery that I think we're all looking for?
Well, I think we have a bunch of issues to deal with that relate to these persistent disparities that we see to do with education and training and all those things. But that would certainly be one of those things.
Senator Scott, in his previous line of questioning, raised the inflation issues, and I know we've seen about a 41 basis point increase on some of our 10-year benchmarks. It's still relatively small. I tend to agree. I think we do need to make a sizable investment right now. I'm not sure the the inflation risks, I agree with you, are not as high as potentially might be. Could you just briefly give some of the tools you've got available as Federal Reserve Chair if you started to see inflation rise at a level that you didn't feel comfortable with?
Well, those are the classic tools that we have. And again, I really do not expect that we'll be in a situation where inflation rises to troubling levels. At this point, the committee, Federal Market Committee, is seeking inflation running moderately above 2% for some time. So the real question is, as we go through this, are we going to find ourselves in a situation where inflation expectations are de-anchored and inflation is moving up and is persistent? And I think we're all very, acquainted with the history of how we got into that situation in the 1970s. We did that in the 1960s, and we have no intention of repeating that. So central banks and the Fed learned how to keep the centrality of keeping inflation under control. And we know how to do that. And that's just by not allowing the economy to just ignore constraints over time. But I think this is not a problem for this time as near as I can figure. And if it does turn out to be, then we do have the tools we need.
We're down to my last 20 seconds, and but let me just, if you want to make some general comments, I mean, I would argue that the pandemic was the first major real-world stress test we've had on our fiscal system since 2009. How do you think overall the system has responded? And recognizing, Mr. Chairman, that'll be my last question. He's obviously, you may want to take that one for the record, but if you want to make some general comments quickly.
You meant financial system, I think, right?
Right. Yes, sir.
Yeah.
Yes, sir.
Well, I think the large financial institutions that are at the heart of our financial system proved resilient. They did, and they've been able to keep lending, and their capital levels have actually gone up during this period. As I mentioned, their liquidity levels are at highs. So I think that the work that we did over the course of the last decade and some has held up pretty well so far, and I expect it'll continue to.
Thank you, Mr. Chairman. Thank you, Chairman Powell.
Thank you, Senator Warner. Senator Rounds of South Dakota.
Thank you, Mr. Chairman. Chairman Powell, first of all, it's good to see you again, and appreciate your service to our country as well. Thanks for being with us today. I'd first like to ask about the SLR exclusion, which is set to expire on March 31st. My colleagues have mentioned it earlier, but did not really get into the heart of the matter. The temporary patch allowed banks to exclude ultra-safe assets, U.S. Treasuries and deposits at the Fed, from their balance sheets. This was important in preserving bank liquidity during last spring's flight to cash, and was common sense move since the Fed can't go bankrupt and the Treasury has never failed to meet its obligations. We all agree that the economy is still in need of fiscal and monetary support. The chairman himself said that banks should be doing more to help their workers and our broader society, but they can't do that when we're tying their hands with excessive and challenging capital requirements. It would appear Congress is going to create even more bottlenecks in our financial plumbing by flooding the economy with about $1.9 trillion in new money that banks will have to hold capital against as soon as the Treasury starts writing the checks. My question is, would you agree that it makes sense to seriously consider extending the SLR exclusion, given the other measures the Fed and Congress are taking to facilitate our economy's recovery?
So I do think that the SLR exclusion, I know that it expires at the end of March, and we actually haven't made a decision on what to do. It's something we're in the middle of thinking about right now. And so I'm just going to have to say that we'll be making a decision and announcing that pretty soon here.
I think the reason for my question is that I think last time around and in the past, we've had challenges with banks that have come in and said, look, we've got folks that want to bring their assets in. They've got to have a place to put it. It is liquid. It's what we're going to have. Most certainly that has impacted our ability and the reason for the SLR in the first place. And it just seems to reason that as you talk about it and as you continue to discuss it, I hope that we really do keep an open mind, and I presume you are keeping an open mind on the need for that, as this amount apparently will be put into the economy in very short order. And so I simply bring it up as saying I think there's a lot of us that think that that's going to be an important part of the discussion to have. Let me lead into another question with you, sir. We've been monitoring the increase in Treasury yields from about 0.9% at the start of 2021 to approximately 1.37% when the market closed yesterday. I understand that this reflects a view of an improving economy, but also comes with increased borrowing costs, increased inflation, and potentially a move by the Fed to increase interest rates down the line. How do you view the increase in Treasury yields in the broader context of our economy at this point?
So first, we look at a broad range of financial conditions, and that's one. It's an important one, but really we look at the whole range of financial conditions, and it's very important to ask, why are rates moving up? And so if you look at why they're moving up, it's to do with expectations of a return to more normal levels, more mandate consistent levels of inflation, higher growth, an opening economy. In a way, it's a statement of confidence on the part of markets that we will have a robust and ultimately complete recovery. So those are the reasons that are behind it, that are behind that move, I would say.
Great. Well, look, thanks. We follow the markets. We follow on a regular basis whether the markets are moving up, they're moving down, and so forth. And I think in anticipation of what your thoughts were going to be today, I think the market was rather volatile. I'm just curious, when you walk into an opportunity like this where you're sharing your thoughts, I know that you want to be very careful in terms of the message that you send, and I think you do a very good job of being very careful in the way that you send the message. But let me just ask, in your opinion, when you prepare for this type of a discussion, knowing the markets are literally watching everything you say, what's the message that you'd like to send? Are you talking, we're going to have stability, it's going to be steady as she goes, we don't see changes coming up with regard to the availability of capital, we don't see changes that are going to impact inflation? What's the message that you really want to send as you share with us today and you're expected to be in front of our committees?
So I guess I'll say a couple of things. First, the starting point is that we're 10 million jobs below where we were in February of 2020, 10 million payroll jobs. So there's a long way to go, and many of those jobs are concentrated in the lower end of the income spectrum, as I mentioned. Many parts of the economy have recovered, but in the bottom quartile, the unemployment rate is probably in excess of 20%, we think. So there's a long way to go. And monetary policy is accommodative, and it needs to continue to be accommodative. We've put forward guidance out both on our asset purchases and our rates. We think that forward guidance is appropriate, and you can expect us to move patiently over time as we see better data coming in. Right now we've had 3 months of 29,000 jobs a month. It's not very much progress. We expect that such progress, which we had earlier last year, we had very fast progress. We expect that that'll begin to return in coming months, and expect us to move carefully and patiently and with a lot of advance warning.
Thank you, Mr. Chairman. Thank you, Mr. Chairman. I apologize for going over on my time.
Thank you, Senator Brown. Senator Warren of Massachusetts.
Thank you, Mr. Chairman. So our economy is suffering through a K-shaped recovery where the wealthy are doing better and better while working people are doing worse and worse. And Chair Powell, you've been pretty vocal about inequality over the past few years. You've noted, I think I've got a quote here from you, that it's been a growing issue in our country and in our economy for 4 decades. You've talked a lot about how inequality undermines opportunity and mobility, and you've described it as something that holds our economy back. So I take it from these comments that you believe that inequality weighs our economy down and stunts economic growth. Is that a fair statement?
Yes, it is.
Good, and I agree with you on this. And the Fed's own data spell out the problem. I think you were just talking about it. The top 1% of families last year received 20% of all the income in this country. And you think that's not good for our economic growth overall. Is that fair?
Well, I would say that the the stagnation of incomes in the lower income area, and also the low mobility that we've seen emerge. Those, to me, are the two most important things that I focus on when I talk about inequality.
Right.
To stagnation of incomes and low mobility.
Right. But we're talking about here income inequality, how much people earn each year to be able to pay the rent and to be able to put food on the table. But inequality also shows up in wealth, which is what families build over time. Money in the bank, home, stock. Wealth inequality is even more extreme in our nation than income inequality. While the top 1% of families, this tiny slice, got 20% of all the income earned in the US last year, the top 1% held 33% of the total wealth in this nation. And now this pandemic is making inequality worse. Unemployment, as you just noted, is now at about 20% for the bottom quartile in this country, meaning that there are a lot of folks out there who are making choices about keeping the heat on or putting food on the table. Meanwhile, the wealth of America's 660 billionaires increased by $1.1 trillion over this past year. Inequality is felt in another way. It's felt in how people pay taxes. The 99% in America pay, on average, about 7.2% of their total wealth in taxes in a given year. But the top 0.1% pay only about 3.2%. That's less than half as much. Chair Powell, does it increase inequality when the wealthiest Americans pay total taxes at less than half the rate of nearly all other American families?
These are, you're getting farther and farther from the, the kinds of inequality that we focus on, and frankly, the ones that we can do anything about with our tools. We can't affect wealth inequality certainly in the short term. We can affect indirectly income inequality by doing what we can to support job creation at the lower end of the market. So I leave to you. Those are really fiscal policy issues that I can't really link those to our mandate. That's all.
I appreciate that you're trying to move sideways on this, but you have pointed out that inequality is a problem in our country, that it holds back mobility, that it holds back opportunity. And I'm simply pointing out that inequality is felt not just in income, it's also felt in wealth, even more so, and that our tax structure makes that inequality worse over time. Extreme wealth inequality undermines our economy, as you have said. It undermines justice, it undermines our democracy. And our tax code focuses almost entirely on income and lets most of the wealth that the ultra-rich families have accumulated just slip right on through. And that just seems to me not right. It's time for a wealth tax in America, a 2-cent tax on fortunes worth more than $50 million. If your fortune's over $1 billion, pay a few more cents. This wealth tax will let us address the inequality that you have been very worried about as chair of the Federal Reserve. It's how we have a chance to level the playing field and build an economy that works for everyone. So thank you for being here, Mr. Chairman, and thank you, Chairman Brown.
Thank you, Senator Warren. Senator Tillis of North Carolina. If not, Senator Kennedy of Louisiana.
Yes, sir. Can you hear me, Mr. Chairman?
I can, Senator. You got two Mr. Chairmans here.
Yes, sir. Mr. Chairman, the witness, what was our fourth quarter GDP growth?
Don't have. I'm reluctant to guess, but it was in the. I want to say 4%.
Right. That's what my numbers show too. What are you and your economists estimating that our GDP growth will be for 2021?
So we'll be updating our forecast. The last forecast we did the last forecast the staff did was in January. My guess is that the data have been a little positive, more positive, but it'll be a good number. We'd be in the range that you see in the public forecast.
How about 6%?
Could be in that range, sort of 5 to 7.
At what point in 2021 will GDP, the level of GDP, equal pre-pandemic levels?
Sometime during the year. It depends on the growth rate. Could be second half of the year.
How about the end of January, or the end of February rather?
I don't know that. It's you asked me the question, the pre-pandemic level or the pre-pandemic trend?
The pre-pandemic level. If you froze the GDP, the economy in February a year ago, at what point will we be back to where we were February a year ago?
In the first half of the year.
Yeah, I see a lot of economists saying at the end of February. Do you disagree with that?
I can't be that specific. I was answering the question about the pre-crisis trend, which is what we're trying to affect.
Well, here's where what I'm getting at. You have strongly encouraged Congress to pass another coronavirus bill, $2 trillion. And I guess tell me, if you could, in just a couple of sentences, why you think we need to do that. If we're looking at 6% GDP growth this year, and as soon as the end of this month, we'll be back where we were in February 2020.
Actually, Senator, I have consistently not taken a position on this bill.
So you don't have an opinion about whether we ought to pass President Biden's bill?
As I've said since the December press conference, I think on every public occasion when I've been asked about it, I've said that it's not appropriate for the Fed to be playing a role in these fiscal discussions about particular provisions and particular laws. It's just we didn't comment on the Tax Cuts and Jobs Act. We didn't comment on the CARES Act. We just it's not our role to do that.
So your opinion is, if we don't pass the bill, you're cool with that?
That would be expressing an opinion. So that's what I'm not doing is expressing an opinion.
Well, would you be uncool with that?
I think by being either cool or uncool, I would have to be expressing an opinion.
Okay. How do you think we ought to pay all this money back that we're going to borrow and that we already have borrowed?
I think that we will need to get back on a sustainable fiscal path, and the way that has worked when it's successful is you just get the economy growing faster than the debt. I think that we're going to need to do that, and that's going to need to happen, but it doesn't need to happen now. Now is the wrong time to be doing that.
Do you think we ought to go Catwoman on the budget and actually look for savings there?
Go Catwoman? I don't know that reference. I think in the fullness of time, we will need to right-size our budget relative to our so that the economy is growing faster in nominal terms than the debt will have to eventually on the path we're on.
Well, do you think that deficits matter?
Certainly in the long run, I do believe they do.
You don't think they matter in the short run?
Again, I think we will need to return to this.
I get to call on Haggerty because he's waited so long.
We'll need to return to this issue, but I wouldn't return to it now. And the way to get after this issue is to get a situation where the economy is growing faster in nominal terms than the debt is.
What if that becomes the case, but your spending's also growing faster than your economy?
Well, no, that is the deficit. I mean, the question really is that the deficit is the difference between intake and spending. So it depends. It's the net of those two.
Let me stop you, Mr. Chairman, because I'm going to have one last question quickly. M2, the money supply, is up, I think, about $4 trillion over the past year. Or 6 trillion, 4 trillion, 6 trillion. What's a few trillion? It's up 26%, the highest amount since 1943. What does that tell you?
Well, when you and I studied economics a million years ago, that M2 and monetary aggregates generally seem to have a relationship to economic growth. Right now, I would say the growth of M2, which is quite substantial, doesn't really have important implications for the economic outlook. M2 was removed some years ago from the standard list of leading indicators, and that classic relationship between monetary aggregates and economic growth and the size of the economy, it just no longer holds. We've had big growth of monetary aggregates at various times without inflation, so something we have to unlearn, I guess.
Thank you, Senator.
Thank you, Mr. Chairman.
Thank you. Senator Cortez Masto from Nevada.
Mr. Chairman, thank you. Thank you, Chairman the Ranking. And Chairman Powell, thank you again for being here as usual. So enjoyed listening to you in the conversation so far. Let me bring up a subject that you and I quite often talk about, which is Nevada. And the tourism and service industry, as we all know, has been so hard hit. We have the second highest unemployment rate in the nation. In this type of labor market, there is no upward pressure on wages because when people are desperate for work, they're willing to take lower paying jobs. But when the unemployment rate is low, employers are more willing to both raise wages to find workers as well as invest more in in-house training and retraining. Can I just ask a question? How does a tight labor market encourage employers to invest in in-house training? Do you have any thoughts or answers to that at all?
I do. And as we've discussed, in that last couple of years when unemployment was routinely below 4%, as low as 3.5%, and where labor force participation was high, had moved up actually, despite expectations that it wouldn't, we saw lots of virtuous effects in the labor market. I actually talked about those a couple of weeks ago. One of them was, I didn't focus too much on, you saw employers investing more in training. You saw employers looking for people at the margins of the labor force. Employers were going to prisons and getting to know people before they came out and giving them jobs as they came out. Great things happening from a tight labor market. And I just think we saw that, and that's why one of the reasons we're so eager to get back to that, consistent with also maintaining price stability. But we really do think, and others saw the same thing we did, which is the broad societal benefits of a tight labor market.
And in particular, now, wouldn't you agree that Congress's investment in workforce development and helping that developing those skills for that workforce would be important?
I do. Again, I don't want to comment on any. I'm not entirely sure whether what you mentioned is in the current proposal, but I would say that the kinds of investment in people that enable them to be more effective in the labor force and policies that enable people to take part in the labor force, those are big things that can increase the productive capacity of our economy over time.
Yeah, I agree. And without on the spot, that's why I've introduced the Workers Act, the Pathways Act. Many of my colleagues are really focused on this investment, particularly now when we have an opportunity to have a long-term impact on jobs. So thank you for that. We jump to just the unemployment and service industry now. This is an area that I know we really hard hit. We have to do more to turn this economy around in our hospitality industry. But let me ask you this. If Congress does not extend and bolster unemployment insurance, what is the Federal Reserve's economic forecast for the impact on communities like Las Vegas that are dependent on travel and hospitality?
So again, I'm not going to comment on unemployment insurance as part of the bill, so I'm just going to stay away from the current fiscal discussions. I really have to do that. I mean, the single most important thing for your service sector employees is to get the pandemic behind us so people can get on airplanes and go to Nevada again and take vacations. That's the single most important economic growth thing that we have. I mean, after that, I think there'll be, and it's possible that that'll begin to happen, relatively soon if we can get the vaccines out and get people vaccinated and people do the right things with social distancing and masks and that kind of thing. You could see that happening relatively soon, which would be great.
I agree, but you would agree there's an investment that still needs to be made. I mean, we are not done here at the federal level with our monetary and fiscal policy and addressing the economic crisis we have. It's one thing to get the pandemic under control. It's another to understand how we turn this economy around as well. Would you agree?
I would agree. And, so we, as I've said, we will keep our policy accommodative. We think we have a significant ground to cover before we get even close to maximum employment. And we hope to do everything we can to speed that process.
Yeah, and let me just say one final thing, because you just said it is the pandemic that has hit state after state and individual communities after individual communities. I hope we do not shift gears here about making investments when some states turn around much quicker and their economy turns around much quicker than ours do, particularly in the service industry. No state should be left behind. And I hope that we would all agree to that we need to pull everybody with us as we address this pandemic and start to turn the economy around. So I know my time is up. I will submit the rest of my questions for the record. I also understand that Chairman Brown has had to get over to Senate Finance to ask a question. He will return. So I am going to sit in his chair temporarily, and I am going to go ahead and turn the gavel over to Senator Hagerty.
Well, thank you, Senator Cortez Masto. And I want to say a thank you to Chairman Brown and to Ranking Member Toomey as well for holding this hearing today as we work toward full economic recovery. And as noted, this is an important part of Congress's oversight of the Federal Reserve System. And Chairman Powell, I want to thank you for your time and your participation today. More generally, I want to thank you for your leadership of the Fed as we work our way through this crisis. And I want to say this, Mr. Chairman, I'm very encouraged by the indications from the Monetary Policy Report, progress that we're making as we come out of this downturn. We're looking at potentially north of 4% economic recovery, or as you and Senator Kennedy were just discussing, maybe even 6% growth for 2021. I find that very encouraging, albeit an uneven recovery. I feel that it's very good news that we're on the way. That also raises concerns that I have, and I'm sure it's been discussed many, many times, about the amount of liquidity that we're going to continue to pump into this economy. We have already allocated $4 trillion in coronavirus recovery relief, $1 trillion yet to be spent, and now we're talking about putting close to an additional $2 trillion into the economy. I won't belabor this anymore. It's been discussed by my colleagues, but I share their concerns about injecting that much liquidity into the economy at a time when we're in the process of recovering, particularly noting our tough and slow recovery after the 2008 recession, given the amount of funding that was injected into the economy then. Chairman Powell, I'd like to shift gears though for a minute. Yesterday, Treasury
That's not
Secretary
me, by the way, guys.
talked about the digital a digital dollar that's overseen by the Fed. It's tied to blockchain technology, something that she said could result in faster, safer, and cheaper payments. You and I have discussed the importance of the dollar as the world reserve currency on previous occasions. It's a vital asset for us as Americans. I would very much appreciate, Chairman Powell, your perspective on whether the Fed should develop a digital dollar that would be held directly by households, directly by businesses, and not intermediated by commercial financial institutions.
Thank you. So we are looking carefully, very carefully, at the question of whether we should issue a digital dollar. And it's something that central banks around the world are looking at and doing so appropriately, because the technology now enables us to do that. And it also enables private sector actors to create their own kind of digital quasi-money type of instruments. So there are significant both technical and policy questions to do with how we would go about doing that. I would say that we're committed to solving the technology problems and to consulting very broadly with the public and very transparently with all interested constituencies as to whether we should do this. I would also say we are the world's reserve currency, and we have a responsibility to get this right. We don't need to be the first. We need to get it right, and so but this is something we're investing time and labor in right across the Federal Reserve System. You may know that the Federal Reserve Bank of Boston has a partnership with MIT looking at one particular thing. We're doing research here at the board. It does hold out the prospect of the things that you mentioned, very positive. It could help with financial inclusion as well. At the same time, you want to avoid creating things that might be destabilizing or that might draw funds away from the banking system. We have a banking system which intermediates between savers and borrowers. We want to be careful about what the implications are of what we do. So a very high priority project for us.
I share your concerns on the need to be careful. I also appreciate the fact that you're going to stay at the leading edge of looking at this and making certain that America does not fall behind in any respect in terms of maintaining our status as the world's leader in reserve currency. It was just a moment of time left. I want to follow up on a more technical comment that Senator Rounds made regarding the importance of looking hard at the SLR exemptions as we continue to move forward this year. I know they're coming to expiration at the end of March, but I very much appreciate your taking a hard look at that as we move forward, because there's a tremendous amount of liquidity coming in. And on inflation, you and I have talked before about the experience in Japan of disinflation. At the same time, I share Senator Toomey's concerns about the asset price bubbles that we're seeing already occur here in America. And again, I appreciate your role in taking a very steady hand in monitoring inflation and making sure we stay on top of it. Thank you very much, Mr. Chairman.
Thanks, Senator.
Thank you. Next, I'm going to call on Senator Van Hollen. I know Senator Brown is asking a question in finance. I'm going to ask a question in E&R, so I am going to also pass the gavel to Senator Van Hollen. Thank you.
Thank you, Senator Cortez Masto, and welcome, Mr. Chairman. Thank you for your service. At the outset here, I just want to underscore the importance of the Fed continuing to move ahead with the Fed Now service. As we've discussed in previous hearings, the United States' outdated payment system is inflicting large and unnecessary costs on millions of American consumers, leading to billions of dollars of unnecessary funds spent. And this doesn't impact people with big bank accounts who are not close to overdrawing. It impacts those who are living paycheck to paycheck. So I see that the Fed has accelerated its timetable a little bit to 2023. If you can move even faster, all the better. You'll be saving millions of Americans lots of money in unnecessary costs. I want to focus my questioning on the issue of long-term unemployment. And in a speech you gave on February 10th, you pointed out that the unemployment rate would be close to 10% if you adjust for the Bureau of Labor Statistics, misclassifications, and people who dropped out of the labor force since the pandemic. This includes over 4 million Americans who are counted in the unemployment figures, but are long-term unemployed, and millions more who've dropped out of the labor force during the pandemic, but would like to get back into the workforce. And you noted in that speech the concerns of persistent and damage from persistent long-term unemployment, what it inflicts on workers personally and their families, and the negative impact on productive capacity for our entire economy. And you stress that monetary policy alone can't do this. It requires a fiscal response. So here's my question. Beyond the overall impacts that the bill were before us or other fiscal responses will make in terms of increasing overall economic growth, based on your experience, would you agree that it's important to very intentionally develop policies to help the long-term unemployed, individuals who even during good economic times were unable to get into the workforce?
I do, and this really is a longer run thing, and I would say, but it's particularly relevant now. As I also mentioned in those remarks, industries are always, growing and shrinking, and workers are moving from one industry to another. That's just a market-based economy working. In this situation, you have that accelerated in a big way, and so many of the people, we may find that many of the people who are not going back to work or not back at work now may really struggle to find jobs because businesses are being automated. We hear that all the time, that computers and sort of automated answers are becoming more and more common. So I think those people are really going to need help to get back into the labor force and get their lives back. So, and that will take, I think, the kind of investments you're talking about.
No, I appreciate that. And we're talking about a focus and an intentional investment beyond the investments that we're making for overall economic growth, right?
Yes.
Yeah. And I also wanted to turn really quickly to the importance of using the right kind of economic measurements to determine the well-being of American workers and families. As you noted in that same speech, unemployment among low-wage workers is 17%, where it was at the start of the pandemic, whereas among high-wage workers, it's only down 4%. So if you take the average, you're not seeing the impact, the disproportionate impact on low-wage workers. I often give the example that if Jeff Bezos had moved to Baltimore City last year, the per capita income of Baltimore City would have gone from $53,000 per person to $175,000 per person, even though nobody was better off individually. So what should we be doing, and what is the Fed going to be doing to make sure that as our economy improves, which we all want it to do quickly, we don't overlook the continuing pain people are feeling because we're looking at averages and not looking beneath those averages?
These people who are struggling in that way are doing so because they were employed in the public-facing jobs in the service industries. So clearly the number one thing we can do to get them back to work is to get the pandemic behind us. And that's not something we can work on here at the Fed, but that's the top thing. Beyond that, I just think it's up to us to continue what we can do to support the economy for really with some patience in order to so that they'll have time to get across. We've talked about a bridge. Most Americans will have a bridge in the end, but there's a group that will really struggle. And I think we need to be mindful of them because really they did nothing wrong. This was a natural disaster. And, as a country, we set out to provide support.
I appreciate that. And I hope as the Fed releases its numbers going forward, in addition to the aggregate average numbers, you also continue to provide us with the impact on lower wage individuals. Thank you, Mr. Chairman. Senator Tillis. And if Senator Tillis is not with us, Senator Loomis. And if Senator Loomis is not with us, Mr. Chairman, is Senator Tillis, I'm told, maybe joining us soon? Senator Moran.
Thank you, Mr. Chairman. Mr. Chairman Pro Tem. And Chairman Powell, thank you for the opportunity to visit with you today, and thank you for your work at the Fed. Just a broad question. How do you view your job in relationship to an administration? So a change in administration from one president to the next, what does that mean at the Federal Reserve from your perspective? Anything or a lot?
Well, our job doesn't change. And at the very beginning of the administration, the personnel don't change. Of course, the one way that administrations really do interact importantly with the Fed is with appointments. And so those will happen over time. And the second thing is, it's a different group of people. We have ongoing relationships by long-standing practice with various parts of the Treasury Department mainly, but also to a much more limited extent with the White House, and we make new relationships and continue to have the same sorts of discussions that we have. But ultimately, the answer to your question is nothing really changes because of the election other than meeting new people.
Chairman, thank you. And thank you for your answer. During my time in the Senate Banking Committee, I've been an advocate for an independent Fed and want the Fed to make decisions based upon best policy without significant political interference, other than perhaps the Senate Banking Committee, anytime that we can take that opportunity. Let me ask a specific question. The most recent monetary policy report to Congress, the central bank indicated that, and I quote here, commercial real estate prices remain at historically high levels despite high vacancy rates and appear susceptible to sharp declines, particularly if the pace of distressed transactions picks up or, in the longer term, the pandemic leads to permanent changes in demand. I have great concern for the commercial property markets and would like to hear what your thoughts are. Is this something we need to wait out? Is it something that needs more attention than we were been able to provide in CARES or COVID relief before? And what does it mean to CMBS borrowers in this market, with this market?
Well, some parts of commercial real estate, office, hotel, and some maybe retail to some extent are under real pressure because of the pandemic, and those changes may be lasting, or they may be temporary, or they may be somewhere in the middle. So this is something that we're keeping a close eye on. There is exposure to the banking system, and as you pointed out, there is significant exposure in CMBS to, I think, the hotel space in particular. So we watch these things. Of course, as I think you also mentioned, the single best thing that can happen is to have the economy recover quickly, so that offices and hotels, can be filled up again. Where it relates to offices, are more people going to work remotely, and so will the demand for office space feel some downward pressure for a while, or even for the long run? That's very possible. We don't really know that, but if you talk to we had a presentation a couple of weeks ago from someone who had done a survey that suggested that there may be, sort of sustained lower demand for office space in particular. So those are things we watch very carefully. We watch it through the banking system, and to see whether most banks are okay on that. Although some of the smaller banks do have a concentration in CRE, so we watch that carefully.
Mr. Chairman, thank you very much. I yield the balance of my time.
Thank you, Senator Moran. Senator Smith.
There we go. Thank you, Mr. Chair. Can you all hear me? So I know poor Senator Tillis was having a hard time with his audio.
We can hear you.
Yes, great. Thank you. Chair Powell, it's great to see you today. And I want to start by asking you a question around climate risk and disclosing climate risk. You and I have discussed before that climate change remains one of the most pressing challenges that we face. It is an economic issue. It is a health issue. I mean, it really cuts across our entire economy. It's, I think in some ways, it's like a slow moving pandemic. And of course, it poses a real risk to the banks that the Fed regulates. So I know that in December, I think it was a great idea that the Fed joined the the network of central banks and supervisors greening the financial system. I think that's a step in the right direction. But my question gets to this. A lot of public disclosure on climate risks is mostly voluntary. It varies a lot from company to company, which makes it really hard to compare risks or interpret what those disclosures mean. So could you talk to us about whether or not you think that climate risk disclosures should be standardized, or should we continue to allow firms to sort of make their disclosures, if they make them at all, in whatever form they choose?
Well, if you permit me, I'd first like to say that, of course, the overall response of society to climate change, which I agree with you is a very important problem, has to come from elected officials in Congress and also in the executive branch under existing law. So that's really where this comes from.
I would agree with you.
We have a specific role on climate change, which is only extends to the scope of our mandate, which is really to assure the resilience of the institutions that we regulate and supervise. So, but on disclosure, and this is really an SEC issue, but I would just say in general, Financial institutions everywhere particularly the larger and medium-sized ones, are working hard on this question. There's been a lot of work done with the task force on climate-related financial disclosure and other groups, and are struggling with this question of different kinds of disclosure that varies by jurisdiction and by institution. And I do think that it's appropriate to allow some of that difference to persist for now. In the long run, clearly we ought to be going to kind of a template and more standardized. But I think it seems to me we can let this process, which is very much ongoing now among our own financial institutions, we can let it, bear fruit for a while. But I think in the long run, though, we have to be going in the direction of more standardization.
So some sort of moving towards a more standardized, reliable, comparable kind of standard of disclosure makes sense to you?
Yes, it does, over time.
Thank you. Thank you. And I just want to also just loudly agree with you that this is primarily an opportunity where Congress and the executive need to step up and take the steps that we need to take from a policy perspective. So I agree with you on that. Let me just, one other thing I'd like to ask you about. There's been a lot of conversation today about the unevenness of the economic recovery and how that is affecting different people differently. And I'd like to hit on one point about this. Last week, I think it was, the Minneapolis Fed came out with a report looking at recovery, people's recovering their employment, and revealed in Minnesota and in the Minneapolis Fed district a dramatic difference in women rejoining the workforce, or in this case, not rejoining the workforce. A dramatic difference between women and men, and particularly particular difference between lower wage women workers and higher wage women workers. This is a huge challenge because in many parts of my state, we actually have a workforce shortage. So it's an economic challenge, as well as, of course, the challenge for families that have lost that really significant wage earner. So Chair Powell, could you just talk a little bit about this unevenness, the challenges of women returning to the workforce as we move through the pandemic, and how you see that affecting our economic recovery?
Sure. So we know that with the closure of schools and with homeschooling, parents have had to stay home. That burden has fallen significantly more on women than on men. And so women, in effect, have had to involuntarily withdraw from the workforce. And that will, hopefully that'll be temporary to the extent people want to return to the workforce. But, that interrupts your career. It may be difficult to get back to where you were in the workforce and replace that work life that you had and sort of limit your ability to contribute to the economy. So it's important, and again, it's not really our policies that can accelerate that, but policies that bring the pandemic to an end as soon as possible would help, and allow us to open the schools up again would certainly help. But you're right, though, that there have been disproportionate impacts, and that's one of them.
Well, and I know I'm out of time, but I want to just toss in there that one of the key pieces of infrastructure for our economy to work, and especially to work for women, is a childcare system that is there so that their young children have a safe, affordable place to go. This has been a big, really kind of collapse in the childcare system during the pandemic, and something that I hope to be able to continue to work with my colleagues on in Congress. Thank you.
Thank you.
Thank you, Senator Smith. Senator Tillis.
Senator Van Hollen, can you hear me?
I can hear you. We can hear you.
I had to reboot my PC. Sorry about that, but thank you for your indulgence. Chairman Powell, thank you for being here, and thank you for the time that we spent on the phone a few weeks back. We have 210 million adults, Americans over the age of 18, in this country, and now we're at a run rate of about 1.7 million vaccinations a day. Now that we've had the lag in January, that's the first and second vaccination. So I think in answer to Senator or Chairman Brown's question, you said the most important thing we can do is accelerate the vaccine. Now we're on pace for having well over half of the country, for people who want to take the vaccine, vaccinated by, let's say, June, early July timeframe. Back when you and Treasurer Mnuchin were before us, when we were debating what a follow-up package should look like, we ultimately passed one that was over $900 billion. We were talking about a bridge. In your opening statement, you also talked about an optimistic outlook in the second half if we continue to make progress on the vaccine. I'm not going to ask you questions about the fiscal policy that we're debating in the $1.9 trillion package, but I am curious if, at least at a high level, do you think it would be prudent to make sure that the additional money that we expend to continue to provide that bridge or build that bridge to recovery, should it be spent on things that are truly stimulative? Do you see any stimulative value, for example, in money coming from the federal government that ultimately makes it into bank accounts and not back into the economy on a short-term basis?
Again, I don't want to comment on the particulars of the bill. Clearly, some kinds of support have higher multiplier effects. People who get the money have different marginal propensities to consume.
The question, I want to follow up on a question that Senator Moran asked about CMBSs in particular. With the eviction and foreclosure moratoriums ultimately sunsetting, and with the CMBSs also being linked in many cases to pension plans and they're potentially being volatile, what specific proactive steps should we consider as a matter of policy, or can you take to avoid what may be some tough waters for that space of investments in the probably coming year?
We don't have, the kind of tools that we have are not really appropriate for addressing those kinds of situations unless they become extremely broad, and I wouldn't expect that. So I think they would come down to whether you want to direct specific assistance.
Well, let me get back to one other thing on asset bubbles. I won't, I'm sure you're familiar with President Bullard's comments about his belief that he doesn't see any potential risk of bubbles. Do you share that view?
I wouldn't comment on what one of my colleagues said. So I guess what I would say is this: we look at a really broad range of things when we talk about financial stability. We've got how much leverage is there in the banking system, households, non-financial corporates. We look at funding risks, and we look at asset prices. The thing we always get asked about is asset prices, but they're only one thing. Ultimately, what you want is a situation where where movements in asset prices do not disrupt the broader financial system. And I think we have highly capitalized banks, and we've done a lot to shore up the parts of the financial system that didn't hold up during the prior crisis. I wouldn't comment on any particular on bubbles. We're not. No one can really identify them. They're for any particular asset. Even now, people have different perspectives. For example, in the equity market, there's some who say there's a bubble. Others say if you look at it this way, there's a lot of. I don't have an opinion on that for this purpose.
Final question. I can't see the timer, so I don't know if I'm out of time. I know I'm close, but I think Senator Van Hollen mentioned the payment system. What's the current status of the implementation relative to the original timelines for implementation and pricing?
So we're right on track and feeling like we'll be up and running in 23, and that's good. We said it would be 23 or 24, so now we're thinking 23. That's really good. And I just think it's a project that overall is
breaking news: Lucid production delay prompted by Churchill SPAC CEO.
Okay, well, I look forward to reaching out and maybe speaking with you all about the implementation and some of the issues on pricing, which have been a concern of mine. Thank you, Chairman Powell.
Thank you, Senator.
Thank you, Senator Tillerson. Thanks to Senator Van Hollen. I was voting for taking the committee. Senator Sinema from Arizona.
Well, thank you, Chairman Brown, and thank you to our ranking member Toomey for holding this hearing. And Chairman Powell, it's good to see you. Thank you for joining us today. Now, I'll admit that when I hear from Arizonans, the first question or concern they have for me isn't usually about the federal funds rate. It's not about the Fed's dual mandate or the money supply curve. Because right now, Arizonans are concerned about getting the coronavirus under control and getting our economy back on track. We want to ramp up vaccine production and distribution, support small businesses, deliver relief to struggling Arizonans, and reopen our schools safely. So my hope is that we will get critical relief to Arizonans.
We lost her.
To think about the future, not just the present crisis. We want a strong economic recovery, and that means ensuring the Fed's work complements our legislative efforts. On December 16th, the Federal Open Market Committee stated that it'll be, quote, appropriate to maintain the current accommodative target range of the federal funds until labor market conditions have reached levels consistent with maximum employment and inflation has risen to 2% and is on track to moderately exceed 2% for some time. So the FOMC's summary of economic projections from December show that most members' projections of the longer run unemployment rate lie between 3.9 and 4.3%. So Chairman, does that mean that the FOMC will not view the US as having reached conditions that are consistent with maximum employment until the unemployment rate is 4.3% or less?
Yes, it means more than that too. When we say maximum employment, we don't just mean the unemployment rate. We mean the employment rate, which is the inverse, and we mean it as a percentage of the population, employment to population, which also takes on board relatively high levels of participation. We look at wages. We look at many things, a broad range of indicators on maximum employment.
I see. Now, the statement lists three conditions for raising rates: full employment, 2% inflation, and projections of. Now, the statement lists three conditions for raising rates: full employment, 2% inflation, and projections of 2% plus inflation. Are all three of these conditions necessary for the FOMC to consider raising its target for the federal funds rate?
Yes, they are.
Oh, well, thank you. That's very helpful. And I appreciate you clarifying that for all of us. You know, as we work to rebuild the economy and reopen safely, we will likely see pent-up demand in the hardest hit sectors: hotels, tourism, and restaurants. And as you know, excessive pent-up demand can cause temporary sector-specific price inflation. But temporary sector-specific price inflation is very different than persistent economy-wide inflation. So taking overly aggressive action on a short-term limited problem risks cutting off relief before it reaches Arizona families. And that's because such action would increase interest rates on student loans, mortgages, and other household debts when families can least afford it. So what tools will the Fed utilize to ensure that you effectively distinguish between temporary sector-specific inflation and the real deal?
So we, as I mentioned earlier, we're very aware of the history of inflation and how it was gotten under control and how it got out from under control. And I would just say, looking at the current situation, we do expect that inflation will move up, in part because of what you mentioned, which is enthusiastic spending as the economy reopens. But we don't expect that the effects on inflation will be particularly large or persistent. So particularly from a sort of a one-time amount of spending due to the current situation. So we'll be watching that carefully to make sure that's right, but we'll be doing that patiently. And we would expect that the longer run inflation dynamics that we've seen for more than a quarter century, where inflation expectations are grounded, inflation doesn't move up very much, or it doesn't move down in bad times, doesn't move up that much in good times. We think those won't go away overnight. We think they'll persist. They may well evolve, but again, we would expect inflation to perform somewhat in keeping with the history of the last few decades.
Thank you, Chairman Powell. Again, I appreciate you being here today. Mr. Chairman, let's work together to get the economy back on track and ensure that everyone benefits from this recovery. Thank you, and I yield back.
Thank you.
Thank you, Senator Sinema. Senator Lamas from Wyoming is next.
Well, thank you, Mr. Chairman. And Chairman Powell, thanks so much for appearing before the committee today. I have two questions. The first one centers on energy. As you know, demand has dropped for energy since the pandemic started, but economists are projecting greater demand later this year and into 2022, even while production declines under the current administration's actions to restrict oil, gas, and coal development. My question is this: are inflationary risks weighted to the upside or downside if a demand shock occurs and reduced production cannot keep up?
The downside for a long time. The situation you described, let's say hypothetically that it does push up energy prices in the near term. That would that would move through headline inflation, but it wouldn't necessarily, it would raise prices. It wouldn't necessarily change the rate of underlying inflation.
Would a balanced energy approach, more balanced than we're looking at right now, be appropriate until the supply-demand curve returns to normal?
We don't really take positions on energy supply. Those are really issues for our elected representatives, notably including you. And I know you're an expert in the energy space.
Well, I'll switch my questions then to innovative payment instruments. FedNow and other instruments like stablecoins and central bank digital currencies have the potential for much higher monetary velocities. So how will this impact the monetary transmission mechanism and collateral availability in the markets?
Well, we don't think they will have much of an effect on monetary transmission, actually. We've had, tremendous amount of payment sector innovation for a long time, really, and monetary policy transmission continues to be about what it is. We change interest rates, and that works its way through the economy, and that supports economic activity or restrains it depending on where interest rates are. So we don't actually think there is going to be a tight connection between, the Fed nows and the stable coins of the world. And I would agree with you. It's important to have collateral, and what we see in the markets is far from a shortage of collateral. There seems to be ample collateral if you just look at the rates that are being paid.
Could higher velocities from innovative payment instruments lead to a refocusing of the monetary transmission mechanism away from the securities markets and towards more of a bank-focused transmission mechanism based on demand deposits?
Again, we don't see the premises that might be right. We don't actually think, though, that there's much reason or evidence to expect showing that these innovations will have much of an effect on velocity or on transmission, for that matter. So we should talk about this online. It's a very interesting question, actually, but we don't really see the premise. But I'd love to hear more.
I'll look forward to those conversations. One more question. Do we need a central counterparty for the clearing of treasuries?
Interesting question, and that's a proposal. We're doing a lot of thinking these days, along with colleagues from other agencies, about the structure of the Treasury market, given what happened during the acute phase of the pandemic, when there was so much selling pressure and there wasn't the capacity to handle it. And one way to do that would be to have central clearing. It certainly has benefits, and I've been a big fan of central clearing in other parts of the economy. It's something that we're looking at. I don't know that it'll wind up being part of the solution, but it's certainly worth looking into. So again, another very interesting analysis and question.
Well, thank you. Senator Sinema, who previously spoke, and I have founded a Financial Innovations Caucus in the Senate, and these are some of the things that we want to explore, plus many other things. So we will look forward to addressing some of these questions through the Financial Innovations Caucus and through this committee. So thank you so much, Chairman Powell, for being with us today and for your insights. I yield back.
Thank you, Senator Lemon. Senator Ossoff from Georgia, you're recognized.
Thank you, Mr. Chairman, and thank you, Chairman Powell, for joining us this morning and this afternoon and for the discussion that we had several days ago. Chairman Powell, it may not be widely known that the Fed's Retail Payment Office, or RPO, is based in Atlanta, and the RPO is responsible for most transactions involving Americans' checking accounts, ACH transactions, direct debit. This is critical financial infrastructure vital to the functioning of our economy. Do you have concerns that cybersecurity threats to the RPO could pose a systemic risk to the U.S. economy? And will you commit to working with my office to review the cybersecurity of the Atlanta-based RPO and to improve it if necessary?
I would agree with you that those are very important issues. I do think that the Atlanta Fed is very, very focused on those issues, but would be, of course, delighted to work with your office in that respect.
Thank you so much. There is no doubt, Chairman Powell, that the COVID-19 pandemic is the most significant drag on economic growth and job creation. But could you step back, please, and comment on what you assess to be the most significant systemic threats to global or national financial stability?
Well, clearly bringing the pandemic to an end in the United States and globally, a real decisive end would take so much risk to the financial system and to the economy and to the people we serve off the table. So you really can't overestimate the importance of getting that done quickly. And we can do it. Just remember, we haven't done it yet, but we really can do it as a country. And it has to happen all around the world, or we'll keep getting, echoes of this, possibly next winter. But this is where we don't want to be. We want to get this done and have it decisive. Beyond that, I think the advanced economies have issues around growth, around an aging population, and low interest rates, low inflation, low growth, low productivity world. The United States to a lesser extent than many other advanced economies. But those are issues that we face that threaten different kinds of stability. Those are big issues that we think about and we have to address to some extent with our policies. So I could go on.
Thank you, Chairman Powell. Appreciate that. And recognizing that you're, as a matter of policy, not commenting on the specific fiscal measures that Congress is considering, can you please guide us through what your thinking would be if Congress were to engage in more ambitious fiscal expansion with more significant or more sustained fiscal support for low or middle income households without commenting on any specific legislation? How might that change the Fed's policy outlook?
Well, we take fiscal policy into account. It's completely, we take it as a given, whatever fiscal policy is. And it's one of many factors that will affect the path of the economy. We are focused entirely on the state of the economy and the path to maximum employment and price stability. That's our focus. Anything that affects that can affect our, what we see, but we'll be looking at the actual data in our forecasts. We won't be reacting to specific policies, if that's what you mean. Again, I would say over the longer term.
Chairman Powell, you've acknowledged the extreme difficulty of economic conditions for low-income and low-wealth households in this hearing. Which provides more direct economic relief to low-income households who may not own stocks or hold mortgages or run businesses? Direct fiscal relief or monetary expansion whose effects are mediated by money markets and the banking system?
Well, I would just say, again, without commenting on a particular bill, fiscal policy, if we're talking about targeting specific groups within society for support, that is the work of fiscal policy. Monetary policy is really not designed to do that.
That's right. So if trying to relieve the suffering of people who are in economically precarious situations in their household, who again don't own stocks, don't own businesses, don't have mortgages, direct fiscal relief will be a more effective means of relieving their suffering than the broader macroeconomic intervention of the Fed through monetary policy. Is that a correct paraphrasing of your statement?
Yes, and that's really been the story of this recovery. It's fiscal policy has really stepped up and done that. We've done what we can too, but fiscal policy.
Okay, I've got just 20 seconds. Chairman, I want to return to systemic risk. The provision of massive liquidity to the financial system, not just since COVID, but since the 07-08 crisis, risks the emergence, as the ranking member noted, of asset bubbles that could pose a systemic risk to the banking system. Do you believe that we have sufficient surveillance and risk management capacity right now to identify those risks before they threaten financial stability?
I do. We monitor financial markets very carefully, and so do many others. It's not a question of lack of monitoring capacity.
Okay, thank you so much, Chairman Powell. Thank you, Mr. Chairman.
Thank you, Senator Ossoff. Senator Daines from, Senator Daines from Montana is recognized. Or perhaps not here. Senator Kramer from North Dakota has not spoken yet. He had checked in earlier. Is he here? Senator Warnock from Georgia is recognized. understand people are voting. Yeah, let me ask one question. I wanted to ask. Hang on a second. I apologize. I wanted to ask the chairman a question about climate. I mentioned I will do this question in writing. I'd rather obviously do it now while we're waiting, and I won't keep you long if the other members don't show up. We know that low and moderate income communities and Black and brown communities suffer the effects of climate change disproportionately. When a hurricane hits, and always have suffered weather disasters, way out of proportion to their numbers. When a hurricane hits, when wildfires ravage entire town or regions, entire spring planting washes down the Mississippi, local residents need government agencies to be agile and flexible in response. What policy changes, Mr. Chair, will the Fed implement to promote consumer protection and community development and do things like ensuring access to cash or other means of payment when these more frequent extreme weather events devastate already distressed communities or whole regions? Are you coordinating on this with the Federal Reserve banks among the 12 banks?
Yes, so that's a good example, really, of the way, to the extent climate change leads to increased episodes of severe weather, we need the banking institutions that we supervise to be in a position to perform really critical functions in the aftermath of those events. You see that. By the way, the Federal Reserve System itself, our reserve banks get the cash. They take the actual physical cash and get it to those affected areas, and it's something they do very well. And we need to be resilient and available to do that, and able to do that rather. And then we need the banks to be able to perform the function that they perform with their ATMs and their branches to get that cash out to people who may be in pretty dire circumstances in the wake of a natural disaster.
Senator Daines from Montana is recognized for 5 minutes.
All right. Thanks, Mr. Chairman. Chairman Powell, it's good to have you here. I just was looking at the T-bill chart and noticing since the 1st of February, the 1-month rates have dropped in half from 0.06 to today, 0.03. 2 months went from 0.07 to 0.02. We're starting to get into that realm here of possibly negative rates, which we saw, of course, briefly a year ago, March. Just want to get your thoughts on that. Is there any issues here of shortage of collateral? What's driving this as you're watching some of these short-term rates approaching zero?
So with T-bills in particular, this would really be a Treasury issue, but I would say, it's a lot of demand for short-term. There's a lot of liquidity, and people want to store it to some extent in T-bills, and there's demand, and therefore that drives down the rates that people are being paid or receiving for buying those assets. From our standpoint, we control our policy rate is the federal funds rate, and to the extent there were to be downward pressure on that because of, for example, the Treasury General account shrinking in size, then we have tools that we can use to to keep that rate in the policy in our intended policy range, and we will do that. And that should also limit the extent to which other money market instruments like T-bills would go even lower or perhaps negative.
So do you have a concern? I mean, I think many of us were surprised. We saw negative rates here a year ago. These rates are getting awfully low in the short term? Is it a concern of yours or not?
Well, again, our principal concern is that the federal funds rate be in its intended range. It's the range intended by the Federal Open Market Committee. We also we do see that there's the possibility that other money market rates could move down, and I think to the extent we're able to keep the federal funds rate in its range, that should ameliorate some of that downward pressure, and that would be appropriate.
Kind of follow up on that same point, Mr. Chairman. The last couple of weeks, we have seen a lot of volatility, for example, in the Texas gas markets that to a degree spread out to other markets. If there were several of these other kind of special circumstances all happening at the same time, Might this lead to a shortage of collateral in the form of T-bills, as seemed to be in the case that we saw here last March?
It's possible. I don't really see that happening, but it's true that there's tremendous demand. And again, the issue of supplying the demand across the curve is really one for the issuer, which is Treasury.
Is there any merit, or might it be a good idea to waive the supplementary leverage ratio for, say, a year until some of these special circumstances we're seeing regarding the recovery from the pandemic in the past, and when perhaps we'll have less possible need for some of the dealer intermediation in the repo market and some of the other short-term markets?
As you, I'm sure, know, the temporary relief that we granted regarding the SLR expires at the end of March, and we're right in the middle of thinking about what to do about that. I haven't got any news for you on that today, but we do expect to make a decision on what to do about that exemption, that change we made to the SLR back last year.
Shift gears and looking at some of the prospects of these asset bubbles. We're seeing signs of speculation across various portions of the economy. Stocks, of course, trading at very high prices to earnings ratios. Ag commodities moving up. Economically sensitive materials such as copper, nickel, they're soaring. Bitcoin's up 80% this year alone. Mr. Chairman, how do we know when, I guess to quote, I think it was Mr. Greenspan, talked about irrational exuberance has unduly escalated asset values, which then might become subject to unexpected and perhaps prolonged contractions?
So as we look at those things that you cited, what many of them have in common is that they're related to expectations of and greater confidence in a stronger recovery. So that's the metals. It's not so much Bitcoin, but it's the metals that you mentioned, and inflation expectations and other securities prices are really related to, because of all the factors that are out there right now, an expectation that the recovery is going to be stronger, sooner, and more complete. And so that's okay. We saw commodity prices moved up a lot in 2008 and 9, and people were worried about inflation. The inflation never came. So it's a healthy sign, I think, there. We're focused on making sure that we're providing the support that the economy needs to get back to maximum employment and stable prices. We've still got 10 million people fewer working now, according to the payroll statistics, and it's much worse than that among the workers in the lower quartile. So that's really our focus. Our focus in financial stability generally has been to have, a banking system and financial sector that is highly resilient to shocks. I'm
going to change the order of this.
All right, Mr. Chairman, I'm over my time at the moment, so thank you. Yield back.
Thank you, Senator Daines. Senator Warnock from Georgia is recognized for 5 minutes. Senator Warnock.
Thank you so very much, Chairman Brown, and I look forward to working with you and also with Ranking Member Toomey and other members of this committee. I'm grateful to Chairman Powell. Thank you so much for taking the time to talk to me 2 weeks ago. I look forward to working with you as we work on a recovery that embraces our whole country, and especially look forward to working with you and Atlanta Fed President Raphael Bostic to help Georgians over the next 2 years. Some have suggested that our COVID-19 challenges with unemployment, with homelessness and poverty will be solved if we simply lift all local restrictions and open up the economy. But since the beginning of this crisis, I've heard you stress time and time again, and something along this order even today as you offered your testimony, that the path of the economy, you said on one occasion, continues to depend significantly on the course of the virus. Would you mind elaborating on why this is the case? Will the economy fully recover
if people don't feel safe and comfortable that the virus is contained?
I would answer your question in the negative. It would not. We know that actually at the beginning of the pandemic, if you look at the plummeting levels of travel and going to restaurants through Open Table, all that data, it shows that people stopped doing those things because of the coronavirus before there were governmental restrictions at the state and local level to do those things. So it really is, to a significant extent, just people wanting to avoid catching, the coronavirus. It's also the restrictions that are in place in some cases on the part of governments. It's not a role for us to express views on whether they should be lifted or not. That's really something for state and local governments. But, clearly if you look at where the 10 million people who are out of work, a great number of them are in those sectors of the economy that have been so badly affected by COVID. And those are the ones where you gather closely and where people are still, not every person, but many people are still reluctant to go to indoor restaurants, for example. And you see sporting events, they're not having crowds. So those are the people who worked in those areas. Those are the ones who are affected. And it's going to be hard for them to go back to work until people are confident, as you say.
So we want the economy to fully recover, but we've got to get the virus under control, and those things work together. Which is why I'm glad to see $20 billion in the vaccine rollout funds and the COVID-19 stimulus package, and I'm going to do everything I can to make sure that we get those funds approved and out the door so that we can reopen and do so safely and permanently. You're also tasked, you're tasked primarily with looking at the whole economy and with the big picture and guiding our country forward. And one of the things that you have to look at as you do that is systemic risks. You and the other governors over the Fed board have to ask, well, what risks are systemic? And in that regard, I'm curious, how broad is your definition of systemic risk? My definition of systemic risk includes a cycle of poverty. It includes things like disparities in wages that mean women make less than men. People of color make less than their white sisters and brothers. It includes food insecurity, housing insecurity, lack of access to health care. These things feed a cycle that limits opportunity, limits upward mobility, and people's ability to reach their full potential, which then has implications for the whole economy. How do you factor these kinds of things in as you take stock of whether the economy is working or not, and for whom is the economy working?
So you've heard us increasingly in recent years talking about these longer run disparities, and why do we feel that we can do that? It is because they weigh on the economy, in the sense that if not everyone has the opportunity to participate in the economy and contribute as much as that person can contribute, given his or her talents and abilities and willingness to work and all those different things, then the economy is going to be less than it can be. And in our country, of course, and every country faces challenges. We're not alone in this, but we do face very persistent differentials that are hard to account for and that weigh on the economy. And those are along racial lines, along gender lines, and other lines. I just think I would say it's widely understood now that we need to do everything we can to bring people into the economy and let them contribute and let them share in the broader prosperity.
Thank you, Chairman Powell. It's clear that the bottom line is that poverty, systemic inequality, wealth inequality are risks to the entire economy and have implications for all of us, that these issues cannot be siloed, which is why we've got to take this into consideration as we push forward COVID relief and then pivot to address longstanding issues of wealth inequality in our country. Thank you so very much.
Thank you, Senator Warnock. For senators who wish to submit questions for the record, these questions are due 1 week from today, Tuesday, March 2nd. Chair Powell, based on a change we made to our committee rules bipartisanly, you have 45 days to respond to any questions. I appreciated the dose of reality we heard from Chair Powell today. 10 million fewer jobs. We're only creating 29,000 new jobs a month. That's unacceptable. As you said, Mr. Chairman, when it comes to our recovery, the job is not done. Talk to any mother or essential worker or mayor. Talk to the people who own barbershops and diners and dry cleaners. Everything is not fine. Much of what we heard from my Republican colleagues today sounds pretty out of touch with the reality that the great majority of American families are living in. It's the same message we heard all last summer, last fall. The stock market's up. Everything is fine. We heard it again today. Certainly the wealthiest sliver of Americans are doing just fine, just like they were before the pandemic. But our job isn't to work for them, it's to work for everyone, as you and I have discussed, Chair Powell. The Fed has multiple tools to increase employment, fight wealth inequality, create an economy that Senator Warnock just spoke about that works for the vast majority of people who get their income from a paycheck, not an investment portfolio. You, Mr. Chair, have a responsibility to use all of those tools towards that goal. I continue and to look forward to continuing to work with you to do all of that. With that, the hearing is adjourned. Thank you so much.
Thank you.
It's over. It's still in on Tesla, guys. I don't plan to sell. I think this might have been the reversal of, as you can see here, we've been getting rejected off the EMA on the 1 minute. Not necessarily convincing, but now as we speak, it's back at 680. Now breaking back above. I'm still holding 17 shares on the 15 minute. We're struggling on the EMA here. What are we on the 5 minute? Barely crossing over. So this is a breaking point here. It's going to test it here. Hopefully we pop it back to 700, possibly by midday. AMC was also one that was hitting 776. We missed this push here. It's pulling back. Still going to consolidate. How did Enki do? I think Enki recovered and then pulled back a bit. Yeah, pulled back in the morning, recovered. Still getting slammed down, but I think this might be a small reversal back up. So let me see. What did you think about that live stream? They're still going to keep on doing the same thing, man. There's going to be no change yet. SPY. GameStop. I think a lot of it is predicated on the vaccine rollout. Most definitely. But then again, people are saying like the economy is on life support, basically. And that all of this is coming down in the next couple of weeks to months. On that 4 hour, we're watching this crucial level here on NQ. We bounced and we're still kind of holding above it, but we still have a couple trading days here in the week. What did you guys think about the live stream? You guys seem convinced? I mean, Powell literally saved the market here on this dip, or also I think we would have seen new lows, honestly, if I'm being honest. I think we would have kept on selling off. Okay, NQ, now it's pushing up as the live stream ended. Yeah, money printer. It keeps on brrr. But who knows? That's the thing I've been questioning myself. How long? CCIV I think is still flat, right? Yeah, it's still 39. Oh, we're up 40 bucks. So we bought 5 shares at 32 here on the dip. We bought the dip on CCIV. This is what I'm planning to just hold for a long time. Walmart, we also bought. We bought a couple more shares down here. Still pretty much flat. Tesla. Inflation. But I think like any pullback, it's going to get ate up. People are still going to be buying at these prices. That's another thing that I believe. Passing a 1.9 trillion bill will continue to push assets up. I agree. Filling pockets of bubbles. I agree. The concern is whether the printer stops printing. That's the thing. You don't know how long they could keep on printing and keep on buying. BTFD. Yeah, just buy the dip. Devaluing the dollar. That's why so many on crypto. That as well. Even crypto. I think just the crypto decline this morning also added to the market sell-off. Even on Bitcoin. Keep in mind, people are tying Tesla's price to Bitcoin. So here it's testing EMA on the 5-minute. It's either going to come on down 670 and crack under, possibly retest 650s, or it's going to curl up. So let's see. PLTR. Oh, AMC had a small bounce. 735. I still think AMC can hit $8 plus, maybe even $9-10 by Thursday. So if you guys just tuned in, make sure you guys subscribe. We're going to be live streaming the earnings. We also go live every morning, Monday through Friday. And drop a like on this video. Alrighty, let's have an alert here. What's your feeling on CCIV? I mean, I bought the dip here, just 5 shares. I'll probably add more if we come down under 30. I think 30 is a fairly reasonable price for CCIV. Probably the whole long term. But as of now, it's just pretty much sideways after it dipped here, pre-market, and yesterday after hours. So Tesla's trying to push. It's kind of holding that level here. If it breaks above 685, 680s, we could retest these highs. This almost looks like a choppy head and shoulders pattern to me. They just see. I doubt Alibaba could crack under 240 today. I don't think it's possible. Seems to be holding 248 here very well, but if it comes down under 240, I'd be interested in buying some under 240 here. We'll be back around this wedge here, 240, 230 level. Possibly play a move back up to at least like 250. See how Neo did. Neo bounce? I'm pretty sure. Yep. Neo following literally the same chart pattern as Tesla. Off the highs, rejected, and now it looks like it's bouncing. XP, EV, XPeng, I wouldn't doubt it. Did the same thing. Pretty much. How's Neo looking on the 4-hour? Same thing as Tesla. Very oversold. On the 4-hour, look. We're on a green candle here on the 4-hour. Let's see if we could get a bullish close on Tesla today. Thoughts on TLRY? Cannabis. I kind of already mentioned this one. I'm waiting for lower prices on cannabis. My favorite cannabis stock is Sundial, SNDL. We were talking about this last year in November. We were trading it like at 50 cents. I locked in profits around 80 cents. Rebought back in at 80 cents. My price target was $1.50 to $2. It went crazy on Wall Street bets, and it was like at $5 pre-market. And that day it got halted. I sold right away. So I took my profits, and I'm not buying back yet. You can see here, still getting rejected off the EMA. Some support right around 123, but I'd be interested getting in on sub-dollar prices. So I'm kind of holding on in cannabis stocks right now. What is the blue line you reference? The EMA, exponential moving average. So mine is set at 13 days. That's what it means, 13. So close 13.0. That's my settings. And the yellow one is simple moving average. Don't like cannabis except the exception of Kern. I haven't heard of Kern. Looks like they have earnings tomorrow. Before or after? It hasn't specified. On the daily, not looking the strongest. Other than the dip buy here in the morning, I don't see any potential for a play. But if you're investing in long term, you have that vision, then by all means go for it. Looks like we got some rejection here at around 684. Let's at least hold 675 support, which happens to be the SMA. Let's hold at least that level. GameStop's just had resistance here at 44 the entire day. After this bounce here off of 40, it looks like we have some support around 42. I think we'll be locked in this range for a while. Hopefully we don't come to retest the $40 mark. Hopefully not. Apple, let's see. 122, Facebook, 262 also coming down. Well, looks like NQ's probably pulling back. Yep, we had a fat red candle on NQ here, so still getting rejected. Here's the thing: after breaking past this resistance here, this downtrend broke past, it could pull back and possibly hold like this level here. So if it comes back down and tests the support we had here, it's not going to be good. So it has to hold one of these levels here. Same thing with Tesla. We had the downtrend here. Draw this really quick. If it comes back to retest the support level of 669, it could come back down to 650s again. So it has to hold right around this range here. I would say nothing less than 670. So it looks like everything literally has the same chart pattern. Everything's following NQ, which NASDAQ is tech heavy, tech focused. Pull up an hour chart on what? GameStop? Under EMA on the 1 hour. See Tesla on the 1 hour as well. So we'll see if it holds, but I'm pretty much going to hold these positions for now. We also have the CCIV. I'm looking to get into PLTR. If it comes down back to the price I bought it at, $32, I'll add more on CCIV. So yeah, wouldn't be surprised if it comes down to like 671 for Tesla. Other than that, any other questions? Tesla 1 hour, yeah, it was under EMA. 1 hour right there. It looks way oversold. Crushed. So hopefully we find some support on Tesla throughout the day on the 4 hour. Like I said, look, the 4 hour candle just went red again. So hopefully we get a bounce. We might have some resistance right around 680, 685, 686, which happens to be the resistance we had back in mid-December last year. So that's pretty much it for this stream, guys. If you guys enjoyed it, remember we're going to be going live on Thursday as well after hours. So we go live Monday through Friday every single day. If you guys found this video of any value, make sure you guys slap a like and remember, subscribe. Don't miss out on the channel. We're going to have more videos out later on AMC, an update on AMC. Other than that, guys, I appreciate everybody tuning in. I'll see you guys later on for another video. Peace out.